Okay.
Recording in progress.
Ladies and gentlemen, good evening. I am Tirthankar Patnaik and I work with the National Stock Exchange. Welcome to the NSE NYU Conference on Indian Financial Markets 2021. Today is the first day of this 3-day virtual conference. We start our program today with a welcome address by Mr. Vikram Limai, Managing Director and CEO, National Stock Exchange, and introductory remarks by Professor Kose John of the NYU Stern School of Business. The day starts with a paper presentation on bank deposit franchise, interest rate risk, and default risk by Nirupama Kulkarni from Kafral and Akshat Singh from the University of Oxford. This would be followed by a conversation with Dr. Duvvuri Subbarao, former Governor RBI and faculty National University of Singapore, Dr. Darrell Duffie, the Adams Distinguished Professor of Management and Professor of Finance, Graduate School of Business, Stanford University, with Dr. Viral Acharya, former Deputy Governor RBI and Starr Professor of Economics, NYU Stern School of Business, on e-rupee, Cbdcs, that's central banking digital currency, and the digital economy, a topic obviously of immense interest in these current times. We would then have a keynote address on the corporate life cycle by the Dean of Valuation himself, Professor Aswath Damodaran of the NYU Stern School of Business. The second day of this conference entails 5 paper presentations on several interesting topics in the field of corporate governance, market microstructure, and financial economics. On day 3, we would have the keynote address by the 2001 Nobel Laureate for Economics, Professor Michael Spence, who would extend the discussions on digital economy that we've had later in the day today by talking about inclusive growth and development patterns in a digital economy. May I now call upon Mr. Vikram Limai, MD and CEO of NSE, to formally welcome you all to the conference and start the deliberations for the day. Over to you, Vikram.
Thanks, Tirthankar, and good evening, everyone. On behalf of NSE, I welcome you all to the 9th NSE NYU Conference on Indian Financial Markets. The NSE NYU initiative was set up in 2012 as a collaboration between New York University's Stern School of Business and the National Stock Exchange. The objective of this initiative is to support and promote research in finance for effective policy making. The 2021 conference marks the 9th successful year of our engagement with NYU Stern. Over the years, this initiative has served as an international forum for academia and the finance industry to exchange ideas and discuss issues related to finance, banking, corporate governance, and capital markets, specifically focusing on India. Having this conference virtually for the second year in a row has enabled us to widen the outreach and the audience. The initiative supports 6 research papers every year, which are selected through an international call for papers. There is a team of eminent professors from across the globe that is involved in the selection process, along with NSE and NYU. These papers are reviewed before and after the conference and are later published under the NSE Working Papers series on our website. A concise, non-technical version of these papers in easy-to-understand language called white papers is also published on the website for the non-academic community. I'm happy to inform you that some of the papers presented in past conferences have been published in prestigious publications of global repute, such as the Journal of Finance, Journal of Financial Economics, and Management Science. The papers this year comprise research in topics such as linkage between deposit franchise of banks and their lending behavior, significance of settlement mode on market fundamentals, impact of unaccepted rating disclosure, high-frequency trading activity, and the effectiveness of additional surveillance measures. We have an excellent speaker lineup this year too. The highlight of the 3-day virtual conference is the keynote address by 2001 Nobel Laureate for Economics, Professor Michael Spence. In his address, Professor Spence will share his insights on digital India, focusing on inclusive growth and developmental patterns in the digital economy. His speech touches upon a subject that is of immense national interest, particularly in light of the government's strong focus on leveraging emerging technologies to improve social and financial inclusion, enhance efficiency, and foster accountability and good governance. We also have a thought-provoking conversation on a topic that's an extension of the address by Professor Spence pertaining to central bank digital currency. The topic has garnered a lot of attention lately with a sharp surge in cryptocurrencies and investments made by Indians in crypto assets. The government is also expected to introduce the cryptocurrency bill in the ongoing winter session of Parliament. And the RBI has expressed concerns over cryptocurrencies posing a threat to India's economic and financial stability. Considering this, today's deliberations on central bank digital currency should provide an interesting global perspective on digital currencies, challenges and risks involved, and the role they play in promoting inclusive growth. We also have a high-profile keynote address this evening by the world-renowned expert on corporate finance and valuations, Professor Aswath Damodaran of NYU Stern School of Business. In his address, he will share his views on the corporate life cycle, its drivers and determinants, and the shift in companies' financials, valuations, and narratives during different stages of a company's life cycle. In light of a sharp surge in domestic and global markets since the lows of the last year post-pandemic, listing of several new age companies this year and an influx of new investors into the market, his address will be very insightful for experienced as well as new investors. Once again, on behalf of NSE, I welcome you all to this virtual conference. I'm sure we will all gain valuable insights from the discussion scheduled over the next 3 days. Thank you very much.
Thank you, Vikram. Ladies and gentlemen, let me now invite Professor Coach John, the Initiatives Program Director, for his introductory remarks to the conference. Coach John is the Charles William Gerstenberg Professor of Banking and Finance at the Stern School of Business, New York University. He has been a visiting professor at the University of Chicago, Columbia University, Temple University, and the Institut d'Etudes Politiques de Paris. He has won several awards, including the Battery March Fellowship in 1983 and the Jensen Prize for the best paper published in 2000 in the Journal of Financial Economics. He has been on the nomination committee for the Nobel Prize in Economics since the year 2016. His recent research interests include fintech, blockchain economics, corporate bankruptcy, dividend policy, corporate governance, top management compensation, institutions, and innovation. Professor Coach John has published over 110 research articles. He has also mentored 106 doctoral students. Ladies and gentlemen, Professor Coach John. Over to you, sir.
Thank you, Tirthankar. It's my pleasure to welcome you to the 9th annual NSE NYU conference on capital markets in India. So let me, Tirthankar and Vikram did such a good job that they stole some of my thunder. So, but let me give you the perspective of this collaboration we have with NSE, a little bit from the academic side. As you know, a lot has happened last year around the world to make India actually more important than ever. Despite the challenges of the pandemic, there is much to be optimistic about India going forward. Based on everything I read, it looks like India has rolled out a fairly successful vaccination program and passed the peak on the pandemic. In addition, India's economic growth looks good. Markets seem optimistic. And India, in fact, holds its place as the third largest economy in real terms. Many other factors also make let us be optimistic about India and India remaining a major economic force. India has a fast-growing and increasingly affluent middle class, a very young and educated workforce, and quite a reform-minded government. Over the last year, international relations have become somewhat more contentious with rising tensions between US and China. With this political backdrop, India, as the world's largest democracy, has become more important than ever. However, having said all this, from an academic point of view, we think we don't have enough high quality, high impact research on Indian economy, Indian capital markets, Indian banking system. You know, there are several reasons why. Maybe the data, the good data is being developed. There has been quite a bit of research on the developmental economic side. As you know, last year's Nobel laureates were all of them had studied some aspects of the Indian economy. But in finance and economics and accounting, for example, the research, high impact research focused on India is increasing, but I wouldn't call it, there is a flood of research which exists. So one of the things from my perspective, I see this initiative actually achieving two goals in this aspect. One is to do high impact research on India, which gets published in the top journals. So that would be one objective, and the second is to use very high quality data on the Indian economy, and that would speak to the research that's being done on India. So I think we have made some strides in that direction, and I would qualify many of the things that we do in the India initiative with the cooperation and support, major support from NSE, is to fill some of these gaps. For example, as Vikram said earlier, these are grants that we provide every year in the grant program. We get a call for papers, international call for papers, and last year we had 62 submissions, high quality submissions, and it was quite a job for us to sort out the promising grants from those. And then this conference, as you know, as Vikram alluded to, brings together first-rate researchers, highly visible researchers from around the world, and it provides a forum for highlighting high-impact research on a wide variety of topics. For example, we have tackled issues such as banking the unbanked, India's tax reforms, health insurance for the poor, debt relief programs, terrorist attacks, caste system, corporate governance issues, banking issues, all kinds of major topics. We've had papers, we had policy speeches, we have keynote addresses addressing all of these issues, which, at least from my perspective, provides major encouragement, major impetus, major, I think it's a really sort of important effect of this initiative. Now, I'm not going to go into the highlights of the program because Tirthankar did a fantastic job. As you know, we have two great keynote speeches coming. We have two very nice policy papers. One is on how does the presence of banking improve the overall health of the community in various parts of India. You know, I think it's such an important topic, and it's a very nicely done paper. So watch out for that. We have another policy paper on the changing gender quotas and the changing scene on corporate boards in India, and how that is affected by paternalistic society in many parts of India and paternal law. So that's another very interesting paper coming up. Let me just, I would be remiss. Let me just thank the NSE for their wonderful collaboration. The team at NSE is just fantastic. We couldn't have put together this conference without their, like, every step of the way. Vikram, you heard Vikram. Vikram has been always an enthusiastic supporter of this initiative. He has helped us, of course, all along the history of the program. Tirthankar Patnaik, who you just heard, he is amazing. He has been, again, every little detail he looks after with his incredible team, Ashiana Salian and the whole NSE team. So I just want to thank them. Amazing support all through this operation.
Likewise.
And
Professor.
finally, I just want to thank the community of scholars. By now, we have built up, in the last 9 years, we built up an incredible community of scholars who do research on India and participate vigorously in all our research input. So thank you all. I hope you enjoy the program in the next 3 days. Thank you very much.
Coach, you want to introduce the first paper now?
Yes. So okay. Now we are starting with the business of the conference. So the first paper is by Nirupama Kulkarni, Akshat Singh. It's a great paper. So I'm going to let, I think Akshat is presenting. Is that right? And our discussant is going to be my colleague, Alexei Savo. So he's standing by as well. And then we're going to have discussion, a free-for-all discussion, guiding the research of the authors. Okay, Akshat or Nirupama, who is going to present?
I am.
Okay, Akshat, go ahead, take over. 20-minute presentations, and then we'll have 12-minute discussion. Yeah.
Sure. Great. Can everyone see the screen?
Yes.
Great. Thank you, everyone, for being here. And thank you to NSE NYU initiative. Today, I'll be presenting some joint work with Dr. Nirupama Kulkarni from CAFRID, where we try to study the relevance of banks' deposit franchise for their risk management. So we're looking at a very important phase in the recent Indian financial history, where there was this credit boom during the middle of the last decade, and which ended up in this significant bust, which continues to affect Indian banks till this date. Infrastructure sector played a very important role, very central role during this boom and bust episode. The bank lending to infrastructure sector during the boom period increased at twice the pace as bank lending to other sectors. And this was followed by a significant rise in non-performing loans, especially concentrated in infrastructure sector after the boom subsided. So in advanced economies and many other economies, infrastructure borrowing is mainly carried out through capital markets and long-term fixed rate bonds. And there is a reason banks usually do not undertake significant infrastructure lending. And that's because of this, the significant maturity transformation that is associated with this. Infrastructure loans are basically characterized by very long maturities, almost 25 to 30 years, whereas banks actually receive their funding primarily through deposits. So almost 90 to 95% of liabilities of Indian banks come from deposits. And these are, by their very nature, very short-term liabilities. And this maturity transformation is basically key and has been studied extensively in the literature. And it's important to understand why Indian banks actually undertook such large exposures to infrastructure sector during this time. And understanding that would require understanding why maturity transformation is really relevant for banks. So a key insight from recent literature has been that banks' deposit franchise has an important bearing on their willingness to undertake maturity transformation. And various reasons have been provided in the literature, which include the reason that we'll be focusing on today, that is the interest rate hedging reason provided by Darrell, Aswath, Nobel. But there are other reasons as well. But the key point is that the key point that is highlighted in all this literature is that deposit franchise is linked to banks' maturity transformation attribute. So what we try to understand in this paper is what was the role of bank deposit franchise in India's infrastructure lending boom. So just to get started, I'll explain the basic the intuition of the link between deposit franchise and maturity transformation provided in Darrell, Aswath, Nobel. So we focus on this particular channel because we find most evidence for this in the Indian economy. And the basic intuition is as follows. Banks with strong deposit franchise can afford to keep their deposit rates low and stable even when policy rates rise. And this goes back to the basic definition of market power. By deposit franchise, essentially mean market power of banks in retail deposit markets. So the basic definition of market power implies that banks can actually afford to charge higher spreads on their deposits and keep their deposit rates stable even when policy rates change. However, there is a flip side to this. And that is maintaining deposit franchise requires significant fixed operating costs. And what I mean by fixed operating cost is essentially the costs that banks have to incur on maintaining their wider spread of branches, on the associated costs of salaries, rents, advertisements in order to attract deposits, etc. So this significant fixed operating costs essentially imply that deposits end up resembling long-term fixed rate debt. And this is key. If deposits were to resemble long-term fixed rate debt, even if they are short-term liabilities, because of these fixed operating costs, they resemble long-term fixed rate debt, then maturity transformation essentially hedges banks against their interest rate risk. Meaning that if banks were to instead have exposure to short-term assets, then they would be exposed to losses when the policy rate were to fall. So therefore, a maturity transformation in this case ensures that banks are not exposed to these losses when policy rates fall. So I just provide you, in order to just to begin, some suggestive evidence that there is some interest rate hedging going on in Indian banks. In net interest margin is the difference between interest income and interest expense by total assets. And as we see, even in the face of significant changes in policy rates over the last 2 decades, the net interest margins of banks has remained relatively stable. And the correlation between this net interest margin and policy rate is almost equal to 0. This implies that banks are actually ensuring that the extent to which their interest income and interest expense change in response to policy rate is matched, ensuring that the difference between the two remains stable over time. So this key intuition on how deposit franchise is linked to the bank's preference for long-term fixed rates brings us to the 2 key elements that we focus on in this paper. One, as I've already discussed, is deposit franchise. This leads to a preference amongst banks with strong deposit market power to lend long-term at fixed rates. And the second key element that we want to focus on is incomplete markets, which is typical, especially of emerging economies. And in simple words, what this implies is that in emerging economies, there may be very few safe long-term fixed rate lending opportunities for banks. And in addition to that, the hedging markets are largely underdeveloped, as a result of which banks may be forced to undertake significant exposures to the few sectors which do cater to long-term fixed rate loans and investments. And that is the key to the analysis that we undertake. Our hypothesis is as follows. Prior to the credit boom, so the credit boom is essentially the period from 2004-05 to 2008-09 or 9-10. So prior to this boom, banks with deposit franchise had significant exposure to long-term fixed rate bonds. Given that economy was in a recessionary phase during this period, there were very few long-term lending opportunities available to the banks. And therefore, banks had parked their funds, banks with strong deposit franchise had parked their funds in these long-term fixed rate bonds. However, post 2005, as the policy rate trend reversed, that is, as the central bank started increasing the repo rate, there was a significant fall in bond prices. And these fall in bond prices leads to mark-to-market losses for these banks on their holdings of long-term fixed rate securities. So banks in India are required to make provisions for mark-to-market losses on their securities held for trade and available for sale categories. So given these losses on account of increasing trajectory of policy rates, banks with deposit franchise had an incentive to switch away from long-term fixed rate bonds to long-term fixed rate loans such as infrastructure. And this is essentially what we try to validate through our empirical or through our DID analysis, where we show that banks which had higher ex-ante exposure to long-term fixed rate bonds were the ones that switched mainly to infrastructure lending once the policy rate started increasing in 2005. And just to give you an overall picture of how this substitution of assets took place, we don't have exact data on long-term fixed rate securities or fixed rate loans, but here I show the long-term securities to assets actually fell drastically from around 2004-05 to 2008-09. And in the same time, there was this switch towards long-term loans to assets. So there seems to be some mechanism, there seems to be some preference for banks to maintain their maturity mismatch, even when they have to substitute between different types of assets. So just to give you a preview of the findings here, we will try to show you that banks try to match the sensitivity of their interest expense rate and interest income rate in order to hedge against interest rate risk. Secondly, we'll try to show you that the deposit market concentration, which is usually used in literature as a measure of deposit market power, is not always a relevant measure for deposit market power. And it is only relevant for private sector banks, but not for state-owned banks. And I'll explain that in more detail. And the third is basically the DID strategy, where we show that banks with stronger deposit franchise undertook greater exposure to infrastructure loans during the boom. And finally, we show that banks with greater franchise ended up with greater non-performing loans post the boom. So I'll skip over the conceptual framework for today, but the one key point that I wanted to highlight is that when the markets are incomplete, then there is a theoretical rationale for long-term fixed rate loans being positively associated with riskier borrowers due to self-selection. And some empirical evidence is provided for this by Vickery in a JFE article in 2008. And this is very important because if it is indeed true that long-term fixed rate loans are associated with riskier borrowers, then there seems to be then there can be this important trade-off between banks trying to hedge against interest rate risk by taking on exposure to these long-term fixed rate loans, but having to undertake greater default risk because riskier borrowers self-select into these type of loans. But that's the key intuition for the conceptual framework. Again, I'll skip over the institutional details for now, but happy to come back to this in the Q&A. The key point here is that India is a bank-dominated financial sector. So the credit boom and bust, unlike, say, some of the advanced economies, was primarily driven by the Indian banks. So the data that we have comes from, so branch level data comes from basic statistical returns provided by RBI, which is at an annual frequency. And bank level income statement data comes from CMI Probis, which is at a quarterly frequency. So to begin with, we show, we essentially look at the interest expense sensitivity and interest income sensitivity of banks to changes in the policy rate. So we do this by regressing changes in interest expense rate on changes in the policy rate, which is in our case, the repo rate. And again, we look at changes in this interest income rate, the sensitivity of interest income rate to changes in repo rate. And these parameters, expense beta and income beta, essentially then capture the interest income and expense sensitivities. One important thing to note here is that whenever I refer to deposit franchise, I'm essentially referring to this expense beta parameter that we've estimated here, because that captures the sensitivity of banks' interest expenses to the repo rates. And banks with stronger deposit franchise would be expected to have lower sensitivity of interest expenses to changes in the policy rate. So they would be expected to have lower expense betas. Just to give you some evidence that there is some matching between interest expense sensitivities and income sensitivities, we show that the two betas are actually highly correlated with a correlation around 75%. And this is basically plotting the betas, the income and expense betas for the cross-section of banks. We undertake the same analysis more formally by looking at a panel setup. Essentially, here what we try to identify is the sensitivity of interest income rate to changes in interest expense rate induced by changes in the repo rate. So it's kind of the same thing that I showed you previously, just a more robust and with the inclusion of bank and time fixed effects. And we show here that 100 basis point increase in interest expense was induced by a change in the RBI repo rate was associated with a 90 basis point increase in interest income. So banks in India seem to be hedged against interest rate risk. Then moving on to the sources of deposit franchise, we'll go back to the regression of interest changes in interest expense rate on changes in the repo rate. And now, in order to identify the differences in sensitivity across state-owned banks and private sector banks, we interact changes in repo rate with an indicator for PSP. And we find that for public sector banks or state-owned banks, the interest expense betas are actually significantly lower than the interest expense betas for private sector banks. And we interpret that this as evidence that in the Indian economy, there is some inherent preference for state-owned deposits over private sector deposits, which allows them greater deposit market power. Finally, we show the relevance of bank HHIs or concentration for their deposit franchise. And we measure HHI as the weighted average of the district HHIs in which a bank operates, with the weights being determined by the fraction of deposits raised in each district. And the key idea is here that usually if the concentration is a good measure of deposit market power, we would expect banks with higher HHI to have lower sensitivity of interest expense rate to changes in the monetary policy rate. And just to show this using a scatter plot, we find that this is indeed true for private sector banks, where we find that there is this negative relation between bank HHI and interest expense beta, but this does not seem to hold for public sector banks. So for public sector banks, there is no strong relationship between this concentration measure and interest expense beta measure. And this can have important implications for policy as well as academic research. Finally, we want to show this link between deposit franchise and infrastructure lending. And to just set up our empirical specification, as I briefly alluded to before, prior to 2005, banks with strong deposit franchise had higher exposure to long-term fixed rate securities. And given the increase in repo rates post-2005, there was a stark fall in bond prices, which necessitated a substitution from these long-term fixed rate bonds towards long-term fixed rate assets. However, since we do not have data on long-term fixed rate bond holdings of bonds, we exploit what is known as the investment fluctuation reserves of banks. And this was basically mandated by the Reserve Bank of India for banks to protect themselves against interest rate risk of investments during that period. It was eventually replaced by Basel I norms, but for our purposes here, it gives us a good indication of the exposure of banks to fixed rate government bond, long-term fixed rate bonds prior to the boom period. So we look at the investment fluctuation reserves to total assets of banks in 2004, at the end of 2004-05, and we use regulatory branch level data to control for hopefully control for district level demand by comparing bank lending within the same district. Just to give you a picture of what the shift that happened during this period, as you see, before 2005, the repo rate was on a falling trajectory. And with 2005, however, as the repo rate trajectory reversed, there was this gap that opened up in the infrastructure lending of above median IFR banks and below median IFR banks. And that is essentially what we seek to capture through our within district regressions as well. So here we look at within district infra-sector lending, controlling for district time fixed effects and bank district fixed effects. And we find that banks which had higher IFR ratio in 2005 undertook greater exposure to infra-sector lending during the boom period. There's nothing special about infra in 2002. We could have used other years as well. We just wanted to normalize infra-sector lending during the boom. One reasonable criticism to this can be that maybe the demand, the infra borrowers demanded their loans from a specific subset of banks, and these specific subset is basically the higher FR banks. So maybe it was demand led. But if that were the case, then we would have expected interest rates on infra loans provided by high FR banks to have risen significantly. But we don't find some strong evidence that infrastructure, the interest rates changed significantly between high FR and low FR banks, which seems to suggest that there was some supply side to this as well. Another important point that we wanted to address is that maybe this maturity transformation was not driven by interest rate risk, but rather an alternative explanation, which is based on liquidity risk. And this liquidity risk essentially suggests that banks with stronger market power are less prone to deposit runs, and therefore they're more prepared to undertake holdings of these illiquid long-term loans or bonds. However, if this were to be the case, then we would have expected low IFR banks to have low exposure to housing sector as well, because housing loans are long-term, flexible rate loans. So if liquidity risk was the main driver of this transformation, we would have expected, we wouldn't have seen this increase in exposure to housing sector by below IFR banks during the boom period. But since we find evidence that this were the case, we can rule out, at least for this period, liquidity risk as the main driver of results, but not the interest rate risk explanation, because housing loans are still flexible rate loans. So they did enable these low IFR banks to match their interest expenses to their interest income sensitivities, that is. And this to provide the same results with the post and exposure interaction, we find similar results that higher IFR banks were associated with greater lending to infrastructure and lower lending to housing during the boom period. But one important question that we need to address is whether high IFR banks were actually banks with high deposit franchise, right? And that's essentially what our entire explanation or hypothesis is based on. And therefore, we run this regression, the same regression as before, where we regress the changes in interest expense rate on the repo rate with an added interaction between high IFR and low IFR indicator variable and the monetary policy changes. And as we would expect, high IFR banks are actually associated with lower sensitivity to changes in the repo rates, which implies that high IFR banks were actually banks which had stronger deposit franchise. Finally, we provide some evidence that the interest expense beta, that is the strength of deposit franchise of banks, is also related to the exposed non-performing loans of these banks. So banks which had lower interest expense betas, that is banks with strong deposit franchise, ended up with higher non-performing loans in the aftermath of the boom. And just to make that point through the within district regressions, we find a similar result that high IFR banks, so banks which had higher IFR ratio in 2005 saw a greater increase in non-performing loans relative to banks which had a lower IFR ratio in 2005. But that essentially is the summary of the results that we had. The key point that we wanted to highlight is that in emerging economies, the deposit franchise and incomplete markets, the combination of these two may be very relevant for bank risk management. And in current steps, what we're trying to do is we use matched data on firms which announced an infra project between 2005 and 9 and firm balance sheet data to study the ex-ante riskiness of the firms, to see whether banks indeed undertook greater risk, undertook loans to these infra firms knowing that they were actually riskier than the rest. And finally, political interference was an important channel during this period. So we seek to understand how that may have impacted our explanation, or how that may be related to our channel. Thank you very much.
Thank you, Akshat. Alexei Savov from NYU Stern is going to discuss the paper.
Great.
Alexei,
Thank
you can.
you.
Yeah.
Yes, thank you very much. Very happy to be here. You guys can see my screen?
Yes. Yes.
Okay, that's great. Thanks a lot. This was a really nice paper. I really enjoyed reading it. It's always particularly nice to see when some of the analysis that we have done in the U.S. to see that it's in some ways robust to a totally different context. So that is always good. But this paper really does a lot more. It kind of pushes things in new directions and has some new insights that I enjoyed reading. So I'll comment on those and focus on those. But I definitely recommend reading the paper. It's also well written. So let me just explain kind of like the main idea of maturity transformation and how it actually hedges banks' interest rate risk as opposed to increasing it. As you know, banks have a maturity mismatch. They tend to borrow short term by issuing deposits, which pay a floating rate, while lending long term using fixed rate assets often. And this is nice. This is important economically because on the one hand, through demandable deposits, you're providing liquidity to households, which households value. And at the same time, through the fixed rate lending, you're providing long-term credit to firms that enables investment and growth, et cetera. But the concern is that while this maturity transformation might be useful, it exposes banks to interest rate risk. In particular, the concern is that if interest rates go up, banks' expenses, because they're floating, are going to rise, while their income, because it's fixed, is going to stay constant. And so therefore, the net interest margin, the difference, the spread that the banks are earning would fall, and banks are going to lose profits and potentially become unstable. Now, what we did in our paper is we showed that actually in practice, net interest margins are completely insensitive to interest rates. They're very stable. And moreover, if you look at bank stock prices, they're surprisingly not too sensitive to interest rate shocks. They're about as sensitive as non-financial companies. So interest rate risk doesn't seem to be very big, either in the cash flows of banks or in their stock prices. And the explanation we found is that this has to do with deposit rates being quite insensitive to market interest rates, despite having this near zero maturity. So even though technically they're floating rate, the rates are actually almost very stable, kind of somewhat fixed. And we show that this is explained by banks' market power in retail deposit markets, which, as Acharya explained, helps banks keep deposit rates low and stable. And then on the asset side, we found that banks are very careful to adjust their portfolio such that the income that they earn on their assets has exactly the same sensitivity to interest rates as their deposits from their deposit franchise. So they're matching the interest sensitivity of assets and liabilities. And they do that by having some long-term asset, and in that way, maturity transformation actually hedges banks' interest rate risk. So just a couple of graphs to show this point. If you look at interest rates, here's the U.S. Context. The Fed funds rate in the dotted line is very, very volatile, moves around, highly persistent. The blue line, that's the interest income that banks earn on their assets. And you can see that it's kind of smooth, and that has to do with the fact that banks are lending long-term, right? And so that makes it smoother than the short-term rate. But the surprising thing is that the interest expenses of the banks, the orange line, is also quite smooth. And that's despite the fact that these deposits, the vast majority of these liabilities that banks have are short-term, essentially zero maturity. And so that's the sense in which interest expenses are relatively insensitive to interest rate despite the maturity. And you see that the gap between them, which is called the net interest margin, here, let me show it to you directly. The orange line now is the net interest margin is extremely stable as a result of this close co-movement, close matching between interest income and expenses. And this flows through the bank's ROA, the return on assets, the blue line here, which is just the difference between the net interest margin and any non-interest expenses that banks have, which are significant, is also extremely stable. Okay. So last point here is, here's the reaction of bank stocks to interest rate shocks using Fed announcements. And you find that when interest rates go up, bank stocks do go down, but they go down only about 2.5% per 100 basis points. So that's a pretty small effect. And more importantly, it's really not any different from other stocks like the overall market portfolio, like the typical non-financial company, which doesn't do any maturity transformation, has very similar exposure to interest rate shock. So again, it's consistent with the cash flows being relatively insensitive. Okay, So this paper, the first thing they do, which I think is nice, is that they confirm that in the Indian setting, banks are also relatively insulated from interest rate risk. And that is to say that they match, just like in the US, the interest sensitivity of their income and expenses to produce that net hedged effect. There are two new things in this paper that I think are very interesting, is that it explores the interaction of this interest rate hedging with default risk, with credit risk. And the argument is that unlike in the US, fixed rate lending in India comes with significant default risk. Basically, fixed rate lending is risky. Now, in the US, that's not really that true, because a lot of the long-term fixed rate assets that banks have are actually Fannie Mae and Freddie Mac mortgage-backed securities, which are extremely safe, obviously, because they're literally insured by the government. And so in the US, there's lots of fixed rate safe assets. But in India, that doesn't exist. And so most of the fixed rate lending was done through these infrastructure loans, which are actually quite risky. So this is actually kind of a general idea. Maybe the Fannie Freddie MBS is more the exception, because it's very natural. The literature has talked about how really only safe borrowers can borrow long-term, meaning that long-term lending is risky, and you have to be pretty safe to be able, as an issuer. Very few issuers are going to be able to do it safely. Okay. The second new thing that's happening in this paper, besides the interaction with default risk, is that they go into exploring really what are the sources of deposit market power. Is it really a concentration of the market, like the Herfindahl index? That's what we mostly focused on in our paper. And they find that that's true for private sector banks. So private sector banks really do need concentrated deposit markets to extract that market power and to keep their interest expenses insensitive. But they find, interestingly, that in the case of government banks in India, that's not the case. Government banks don't really need to have concentrated markets to do that. And the idea is that government guarantees that these banks have give them that edge without the market concentration. They provide them market power. They provide them with you might think of it as a captive or inelastic depositor base without needing to have a high Herfindahl index. So I thought that was a nice result as well. So here's the main kind of headline matching results from the paper. You can see that the policy rate is moving around. It's actually not moving around that much. So the sample is a little bit short, but there's enough variation here to see that the net interest margin of banks, the red line, is completely stable and unexposed to interest rate changes. Now, interestingly, and the paper doesn't comment on this, and I think they should, ROA, if you look at the blue line here, actually declines here at the end together with the policy rate. So it looks like ROA is a little bit more exposed. But what that must be driven by is not interest rate exposure, because it's not captured in the NIM. What it's driven by is some kind of non-interest item, right? Some kind of non-interest item. And I suspect that has to do with loan losses during this period, the default risk that is exactly what the paper is looking at. It starts to kick in around this period. These banks start losing money on these loans that are not performing well. So I think that's actually something that fits in very nicely with the results of the paper, that while the interest rate risk is reduced, the default risk is there and maybe even increased. Couple of comments. I was a little bit struck that there's actually less maturity transformation by Indian banks than in the US. So if you look at the maturity gap, you find assets have maturity of about 3 years in the Indian banks, which is a little bit less than the US, where it's more like 4 years or 4.3 years in our sample. And moreover, the liabilities are already somewhat longer maturity. So the liabilities repricing maturity is about 2.4 years, which is higher than in the US. In the US, this number would be something like 0.3. So quite low. Most of demand deposits are demand deposits overnight. So the maturity mismatch is less. It's there, but it's less. Both the assets are shorter and the liabilities are longer. And one of the things that I think makes me think is that the US deposit markets, we talk about, India as the developing economy and the US as the developed one, but it's actually the US where deposit markets are extremely non-competitive. I've looked at other countries in Europe, and you tend to find that there's more deposit market competition than in the US. And so perhaps that's one of the explanations for why our banks have a bigger maturity mismatch, the relatively high market power here. Okay, I'll speed up a little bit. So these are the matching results. Actually, I went over them. I think they're really nice. They show you that there's almost perfect one-to-one matching between the interest sensitivity of assets and of income and expenses, which means that the net interest margin is completely hedged in the cross-section as it is in the time series. Now, again, something that the paper doesn't talk about is when they look at ROA, ROA actually doesn't seem to be stable. So banks with the higher interest expense sensitivity have less sensitive ROA, more negatively exposed. And there are no stars here, but if I compare the coefficient to the standard error, it looks like it's significant to me. And so, again, I think that that's suggestive of this default risk story that they're talking about. The banks with the high market power, which have less sensitive interest expenses, see a bigger drop in their ROA when the policy rate starts to come down late in the sample. And so again, I think that might be another way of seeing these default risk results that they had, which I think is nice and definitely should explore more. The result on the infrastructure loans, which is very interesting, showing that banks with what they think of as high deposit franchise invested disproportionately in these infrastructure loans because that's the source of fixed rate lending. That's the source of maturity, long duration that you can get in this context. So I think this is a nice result, and it's highly saturated with district time fixed effects. As Acharya mentioned, there is a concern here about loan demand. So obviously, this boom started when it did because there was greater demand for infrastructure loans. As the paper talks about, the previous sources of funding had dried up. So there's an overall increase in demand. And the worry would be, as Acharya said, that this demand might be disproportionately going towards these high investment funding fluctuation reserves banks, because that's the measure that they're using here. Now, he showed some nice results that weren't in the paper on the interest rate not going up. So maybe that's suggestive that it's not this demand story, at least alone, going on. But I do feel that it would be better in this regression if you could use a measure that's more directly related to the deposit franchise than this investment fluctuation reserve. While that investment fluctuation result is correlated with the expense beta, as the paper shows, it's potentially more endogenous because it's coming from the asset side, whereas having some kind of measure coming from the deposit franchise side would be more, as in the rest of the paper, I think would be more convincing for this result, and would be nice to see. Last couple of comments, since I'm sure I'm running out of time. This is the result showing that public sector banks have the same low insensitive deposits, regardless of the Herfindahl index, regardless of the concentration of their deposit markets, whereas private sector banks have this decreasing line showing that to get a low deposit sensitivity, you really need a relatively higher Herfindahl index. Now, all these Herfindahls are a little bit low. I think that's because they're working at the district level, which is quite large. I would imagine that the relevant measure for deposit market power is a more local, smaller market than the district. But nevertheless, the result already shows up here, which is nice in the differential between the government banks and the private sector banks. Now, the thing about this result that surprised me a little bit is that in the US, I very much think of government guarantees and Herfindahl market concentration as complements, not substitutes. And the paper is saying that it's one or the other. But if you look in the US, it's true that Herfindahl matters, so concentration, but it's really only you only see these low sensitivities for insured deposits. Uninsured deposits tend to have very high interest sensitivity, whatever your Herfindahl index is. And so there's clearly, to me, some complementarity between government guarantees, deposit insurance in the US, more limited here in the India context, and market concentration. So basically, once you have deposit insurance, your depositors are kind of not constantly paying attention to what you're doing. And then that allows you, if the market is concentrated enough, to pay them a relatively low rate. So I think there's a complementarity there. Okay, I'll conclude. I think it's very interesting to see maturity transformation without interest rate risk in an important emerging market. I like the connection to default risk. I think the paper could maybe explore it more. I'm particularly interested whether it's more general than just this infrastructure boom. Like you could say, well, maybe they just happened to have this infrastructure boom and it didn't work out because some of these loans end up being non-performing. Is the connection more fundamental than that, or is it just this one time? And for that, I think what you'd want to have is some kind of ex-ante measure of default risk and see if it's more systematic, perhaps for further work. And again, one of the takeaways for me is that maturity transformation, even if it doesn't expose you to too much interest rate risk, is still limited. There's only so much you can do. On the liability side, of course, because you might be exposed to competition from deposits, but on the asset side, because long-term lending is risky. And so you can pull out your maturity mismatch. Interest rate risk might not be a problem, but this default risk starts to come up. I think that's a very nice insight, and I enjoyed learning about it from this paper. Thank you very much. Coast, I think you're muted still.
Thank you, Alexei. Great job. We have a few minutes for a discussion, but before we start that, Akshat and Nirupama, do you have some comments to Alexei?
Yes. First of all, thanks a lot, Professor Subbarao, for doing this. This was really helpful. So I'll try to address the main points that you raised. First of all, ROA decline. Yes, we did check that out, and you're absolutely right. So that seems to be coming from loan losses. So there was this asset quality review which started in 2014, which unearthed a lot of non-performing loans in the Indian banks and led to a significant fall in ROA. The second point that you raised is something that we were also quite concerned about: the less maturity transformation undertaken by banks in India. And I think one thing that is specific to India is that the loans are sometimes structured in such a way that they do not actually reflect the true maturity on the balance sheets of the bank. So for example, an infrastructure loan, even if it may be for a maturity of say 20 years, is kind of structured with these reset clauses so that on the balance sheet, it may be recorded as, say, a 5 or 7 year loan. And that happens for a lot of different sectors as well. So at least our opinion so far, I think we'll have to talk to more experts, but is that the true maturity transformation is somewhat hidden for the Indian economy. The ROA point regarding the standard errors, I'm sorry about that. That was an error with the code. So the standard error, so it is insignificant, but your point regarding the magnitude of those results still stands, and I think we'll need to pursue that further. So why we don't use interest expense beta? I think that would have been the natural choice, especially in comparison to your housing paper. I think essentially that's similar to what we are doing. But the reason we cannot use it is we do not have enough pre-boom data to compute the interest expense betas. But the deposit HHI, I think we could definitely use. Finally, the ex-ante risk, I thought, we were quite excited about that as well, and you're absolutely right. The hope at least is to make this more general, and I think that would require us to look at the ex-ante riskiness of these loans. The point about the complementarity between insurance and concentration, I think, was quite interesting. I'll need to think more about that and maybe discuss that with Nirupama as well. But thanks a lot.
Yeah.
Great. Yeah, go ahead, Nirupama.
So I just wanted to add two things. One is about the deposit HHI. Because we have this sort of public sector bank market power as well as HHI, it's a little bit, we're unsure about how to combine those together to get one measure. And the second one is again about the ex-ante default risk. I think it's also important from a policy perspective because there's a lot of debate about whether banks knowingly went in knowing that the infrastructure loans were going to be risky. And some of the aggregate numbers say that yes, in 2004 itself, these infrastructure loans were turning bad, so they might have known it. But that's something we want to explore. Thank you again for the great comments.
Okay, great. Thank you. We have a few more minutes for some comments. I did see a comment in the chat from Madhvi. Maybe you can, I think she wanted to know whether the distinction private versus public banking sector, maybe you can explain the results. I don't know who wants to take that, but that was a comment I saw in the chat.
Right. If I'm not wrong, I think
if you want to share the slides, you can do that, Akshat. Yeah.
Right. So just to answer the question briefly, I think we actually run all of our regressions for both private sector banks and public sector banks. The problem with looking at them separately is that sometimes you just don't have enough data, because private sector banks, we have around I think 15 banks in our sample. But we do try to provide all results for both set of banks.
All right. This is Madhvi here. Professor Koze, can I ask something more?
Sure, absolutely. Go ahead.
Okay. This was a very interesting discussion. And I was wondering if Indian bank mergers were part of the study. Did you basically look into that? Because a lot of banks merged. And I was wondering if that event would have also led to some kind of changes in the, infrastructure loans, NPAs, etc. Because now the balance sheets would come together and the interest rates, etc. would have also changed.
Yeah, I don't think we have looked at that, but that's a very interesting point. I think even from an identification perspective, we should sort of think about it. Yeah, that's a nice comment.
Yeah, because it's a very nice shock for your study. If probably it's just a suggestion, you might want to look into it.
Thank you. Yeah, that makes sense. We'll look into it.
Madhu, you can unmute yourself. Madhu Kalimipalli has a question. You can unmute yourself and ask your question. Go ahead.
Hello. Good morning, Kos and everyone. Yeah, it's just a quick question about this exogenous shock. Nice paper, great insights. Any comments on this ILFS as an exogenous event to study what Alexi was saying?
We actually stopped before the ILFS event. I'm not very sure whether there is a direct sort of insight we can glean from this. But if you're thinking about deposit flows from private to public, I think we should think about it a bit more. But like the nature of our data is such that it stops at 2016, so we can't really extend it beyond. But yeah, we'll think about it.
Thank you.
Thank you.
Harish, you can ask your question, or do I need to unmute you? Oh. Okay, let's see. Harish, are you able to ask your question, or I think I need to unmute him.
Yes. Thank you, Kos.
Okay, go ahead.
So I was wondering about like how the 2008 bailout of different public sector banks might have impacted this scenario, because essentially these bad loans given, because you are working at a district level and they were focused on that particular districts in different areas which were more exposed to this, maybe this lending or might be some other lendings, but essentially the default risk or the NPAs might have some kind of, there may be something, I'm not very sure, but of course you can figure out. Yeah,
that's true. And in fact, we and I think you were referring to the forbearance measures and things like that. So one thing is that post 2008 there were these forbearance measures given to
yes.
Right?
Yeah,
and we see it shows up in our NPAs. That's why you see that there was this prolonged period after 2008 until around 2014 where you didn't see any movement in NPAs, because banks were basically you're told that you can just treat them as standard assets and not as non-performing assets. But once I think in 2013, it was announced that the asset quality review was announced, which said that okay, starting 2015, you'll have to start recognizing your bad assets. So that's when we see this jump up in NPAs.
Yeah. Thank you.
Okay. Any more comments or questions?
So we have a few from the webinar, actually. People are watching us on the webinar.
Okay. Yeah. Go ahead, Tirthankar. If you can unmute them and
I don't think we can do that, but let me just read out the question. Maybe
okay. Go ahead.
Everyone can have a look at that.
Yeah. Go ahead.
So there's a question from Maulik. Is undertaking default risk a part of the calculated risk to compensate partly for interest rate risk? And if so, was there risk management? How come undertaking default risk by onboarding long-term assets is not uniform across banks?
Right. So the first point, that is what we actually want to put across through the conceptual framework that we're working on right now, this trade-off between interest rate risk and default risk. And if there is this trade-off, then banks will actually knowingly, so suppose the banks are actually myopic and they care about the profits today, but not as much about profits tomorrow. And then if there are these trade-offs between interest rate risks and default risk, then banks may knowingly decide to take on more default risk because they want to protect their interest margins today without caring as much about the margins tomorrow, say. So in that case, they will knowingly decide to undertake. They can knowingly decide to undertake more risk, and that's why the ex-ante analysis is crucial for this aspect of the model, because we have to show that banks knowingly took more risk ex-ante. Sorry, I forgot the second point.
The second point was. How is this not uniform across banks?
Right. The main idea is that incentives to carry out this maturity transformation depends on the deposit franchise of banks, and the deposit franchise actually differs across banks. So there are some banks which greater market power. We hypothesize that those would be the banks which want to take on greater risk which want to undertake greater exposure to long-term fixed rate assets. And therefore, the exposures would be heterogeneous across banks depending on their deposit franchise.
Makes sense. I hope I don't see any more questions. Because, I think we are done with the questions here on this page.
Okay. Thank you all. Thanks to the presenters. Thank you, Alexei. And thanks for everybody who raised interesting questions. We are just on time, I think. Yeah, go ahead.
There's one more.
Yeah.
Okay. Is there time for another one?
Yeah, we have.
So Amol Agarwal asked, the results are presented from the traditional maturity transformation angle. However, in 2014, the Bank of England paper pointed that it's loans that create deposits. Any thoughts on whether paper findings will need tweaking if one takes the Bank of England angle? Can we also bring Minsky's thoughts on the paper?
This is, I'm not understanding the question. So maybe I'll refer to the Bank of England paper. I think it was a 2014 paper.
Makes sense. All right. Thank you.
Okay. All right. I think we are ending this session right on time. Right now we have a 10-minute break, and we have coming up two very interesting events. The first event is going to be a panel discussion on the e-rupee, Cbdc issues, and the digital economy, which is now, the big hubbub in India. So we're going to have Subbarao, Darrell, Duffie, and Viral Acharya as the panelists. Okay. And after that event, we have Aswath Damodaran as the keynote speaker. So we have actually a 9-minute break, and we get back at 8:50 Eastern Time and 19:20 Indian Standard Time. Thank you, guys.
Thank you, everyone.
Hi, Pradeep.
Hi, Pradeep. Saurabh, could you put on the timer, please?
Hi, Kauz. Hi, Tirthankar.
Hi, Pradeep. How are you doing?
I'm okay. Thank you. Lovely seeing you.
Thank you. Yeah, no, so far it's going well. We have, as you know, Subba and company coming up for a panel in about 9 minutes.
Yeah, I know. I don't know him personally, but I have know him through a close friend, and we are getting Subba to come to Oklahoma too.
Oh, great,
Yeah.
great.
Okay.
Yes,
He'll
great,
spend
great.
some time.
Okay, great. Is he in Singapore normally or what?
He used to be he used to have visiting relationship with Singapore. And we have a close friend who's a prominent scientist and entrepreneur, who's Venki, and he's joined University of Oklahoma as a director for an Center of Entrepreneurship.
Oh yeah, I know Venki. Venki was both Venki and Subba were 1 year senior to me, so I know them both very well. Yeah.
Okay, it's strange that we never got to talk about you. I mean, that's now I have another topic to talk about.
Hey Subba, how are you doing? Can you hear us, Subba? Where is Subba? Hi.
You're muted.
Subba, you're muted. Yeah.
Yes, I'm here. Thank you.
Okay, so we were, it's good to see you. Pradeep was just talking about Venki.
Yeah, hi Subba. I'm Pradeep. We have
Hi Pradeep. Yeah, wonderful seeing you virtually.
Yeah, absolutely.
Yes.
Same here. Likewise.
Look forward to seeing you in person soon.
Yeah, we Venki and
my colleague Viral Acharya, we have Subbarao, and we have Darrell Duffie. So I'm going to turn it over to Viral, and he's going to start the panel discussion. He's going to start the conversation on Europe, CBDC issues, and the digital economy. Viral, you take over.
Thank you, Kos. I think I should confess right at the outset that other than digital banking, cryptocurrencies and CBDCs are not exactly my forte, but I've been learning about them over the last 2 years, probably like many in the audience. So I'll pose some questions that Darrell and Dr. Subbarao could use just as segues to inform us in any case about the remarks that they had in mind. Maybe I'll start out with Darrell, if that's okay, Dr. Subbarao.
Sure.
I had two sort of questions in the context of India specifically on crypto assets. The first observation is that India has one of the most advanced payment systems as far as the banking exchanges are concerned. As many in the audience know, it's called the Unified Payment Interface, UPI. It's a set of software standards, APIs as they are called, or pipes, which connect banks through a central utility for payments, which is sort of essentially a public utility for all practical purposes. And on top of the sort of unique identifier and its verification, that creates a very seamless way of doing interoperable payments between any two individuals and the government, individuals and the businesses, business to businesses, and so on. So my question for Darrell is, in a world like this, where most of the payment efficiencies are already realized within the banking system, what do you see as the role of cryptocurrencies as a medium of exchange in a country such as India or some other developed markets which have similarly evolved payment systems?
Thanks, Viral. And let me just take a moment also to thank Professor John and, of course, Dr. Subbarao and yourself for the chance to appear here. It's a really wonderful opportunity for me to learn about the situation in India. And, of course, answering a question about the situation in India is treacherous for me because I'm surrounded by the experts. But let me simply reemphasize the irony in your question, Viral. The irony is that countries like China and India that already have very advanced mobile payment systems, at least in the case of China, throughout its urban centers, over 95% of city dwellers in China are using mobile payments on a daily basis, even before the digital currency arises. And with the benefit of UPI, which you mentioned for India, plus the identity systems available, including Aadhaar, it would seemingly be the least important of the major countries to make a case for a central bank digital currency, given how advanced it is already, and the potential future for commercial bank-railed payment systems like UPI. But nevertheless, as we all know, because that's why we're here today, RBI's Governor Das has already initiated pilot testing starting this month in India on the basis of, I would say, making sure that as paper money is reduced in circulation in India, partly under the efforts of the government, that there is still an official digital currency representing official fiat currency in circulation. That's the reason that Sweden, for example, which already also has mobile payments in a very good state, is introducing perhaps the e-krona. I don't think this move necessarily means that the RBI will go ahead with this project. Governor Das has already mentioned that there are some technical hurdles like security and also making sure that the CBDC doesn't disrupt the banking system. In my view, by the way, I think the banking system in the United States deserves a big amount of disruption in the payments area because they're not doing a good job. There's not enough competition in the U.S. for CBDCs. CBDCs are not here to compete with banks, and the payment system in the U.S. is very inefficient and costly. But India, seemingly, the banks have this under control. And the case to be made for a CBDC has to be made based on perhaps the new digital economy and smart contracting, or perhaps the fact that the RBI wants to be sure that as paper money goes out of circulation, that there will be an official fiat currency in circulation in digital form. I think those are the best positive cases. There are negatives as well. The private sector can often do innovation more effectively than the government sector. So one may ask, why does the central bank need to do this? And that debate is going on all around the world, where most countries are grappling with this issue. But let me not go on at greater length, Viral. You asked the best question first.
Thanks. Thank you, Darrell. Let me turn over to Dr. Subbarao. Sir, in the context of India, what do you think has given rise to cryptocurrencies as a medium of exchange, in spite of the payment efficiencies that Darrell has also referred to? In fact, payment efficiencies, even relative to fairly advanced financial systems such as those of the United States. And the second related question, if I could throw in, is where do you see the role of central banks' digital currency in India? Do you think there is a strong case? If yes, what are the merits and what might be some of the pitfalls that RBI would have to worry about in due course?
Thank you, Viral. Let me first address your second question, which is what is the motivation for the RBI to issue a central bank digital currency? I think India and several emerging markets are driven by both fear and opportunity in issuing CBDCs. Let me first talk about the fear dimension. The fear is that private cryptocurrencies will come and displace the fiat money issued by central banks and thereby impair the monetary policy sovereignty. Let me give some context to this. When Bitcoin came out a dozen years ago, when I was governor of the Reserve Bank of India, central banks were quite nonchalant about it because they believed that Bitcoin cannot actually take over fiat money in all its functions, like unit of account, a medium of exchange, a store of value. In the event nothing like that happened, Bitcoin and its clones degenerated into just asset classes. But the story can be quite different with stable coins. Unlike Bitcoin and its clones, which are backed by nothing more than an algorithm, stable coins are going to be backed by reserve assets, such as the dollar or the euro, one-to-one. If they're backed by reserve currencies, they'll have the gravitas to pull transactions away from the banking system into their own medium. When that happens, central banks fear that they will lose control over the setting of the interest rate, over money supply, and therefore over inflation management. Is this probable? Who knows? Consider Diem, the stable coin to be issued by Facebook. Facebook has a client base of 2 billion, has a very enticing suite of services, has enormous network impact. It can compete with fiat currencies, with domestic currencies of emerging markets and displace them. And central banks are worried that as the use of their own currency diminishes, they will lose monetary policy transaction. What compounds this worry is that most stable currencies are going to be linked to the dollar because the dollar is the world's dominant reserve currency. And I think America itself is going to be quite nonchalant about regulating stable coins linked to the dollar. In fact, America might see that as an advantage because it will extend the dominance of the dollar around the world. So we'll land up in a situation where there are stable coins linked to the reserve currencies, is linked to the dollar, America being nonchalant about regulating them. So outside of beyond the regulatory gaze, these stable coins, what is to prevent them from delinking from the peg and becoming independent creators of money? So central banks like the Reserve Bank of India are, I believe, concerned that when cryptocurrencies like stable coins gain dominance, gain traction, their monetary policy will lose traction. I think there's also another reason. Let me give another important reason why central banks have driven into CBDC, particularly emerging economy central banks like the RBI. Like Darrell said, cash is on its way out. Even before private cryptocurrencies came, cash has been on its way out. In Sweden, as he said, it's difficult to find a paper krona bill. In China, most young people have not seen currency. All they know is Alipay and WeChat. Even in India, the first generation digital payments like credit cards and debit cards, they've given way to private wallets, mobile payments, online payments, technology platforms like Google Pay and Amazon Pay. So what's happening around the world, including in emerging markets, is that people are increasingly depending on private payment systems. And these private payment systems are vulnerable to hacking, vulnerable to outage. And if that happens, central banks are concerned that the integrity of their domestic currency will be impaired. So they want to provide a backup, fail-safe, centralized payment system via the CBDC. So those are some of the two motivations driven by anxiety, driven by fear, as a defensive reaction that is motivating central banks of emerging economies like the RBI to go into CBDCs. I'll stop there.
May I react, Viral?
Absolutely, Darrell. Yes.
Yeah. So I think Dr. Subbarao has made the most perceptive points on why many countries are introducing CBDCs, which is they don't wish to be invaded by foreign digital currencies, whether based on a reserve currency or an undesired cryptocurrency. My country, Canada, has developed a CBDC. It's developing it now. It's not deploying it until necessary for exactly this eventuality. And the European Central Bank has said the same thing. My view, however, is that countries such as India can afford to be somewhat nonchalant relative to a small open market, emerging market economy, which has open capital borders, and which would have a difficult time preserving its monetary sovereignty in the wake of a global, let's say, dollar stablecoin, as Dr. Subbarao suggested. But in the case of India, again, I'm speaking treacherously here because I'm surrounded by experts on India's financial system. But I would have thought that because, first of all, it has some degree of capital controls, because it is such a huge monetary system, the world's largest democracy also probably has the largest number of currency users, in this case, the rupee. And because it, as you mentioned, Darrell, India has made vast leaps forward in digital payments. It already has effectively a very stable, effective mobile payment system that, in my view, would do about as well as a CBDC in deflecting any undesired foreign digital currencies. I do agree, by the way, with Dr. Subbarao's comment that it would serve U.S. foreign interests to have a dollar stablecoin circulating widely throughout the world, even though, however, it would be disruptive to small emerging market economies. And therein is a challenge for U.S. policy. I'm pretty confident the Fed and other central banks will not wish to have their CBDCs circulating internationally in an invasive way. But then with respect to foreign policy, what about private stablecoins? For example, USDC or a diem. Would a country like the US sit back and let another country with a large dominant currency allow its stablecoins to get in place a kind of monetary regime in a region of the world. China might be an example. China has a stablecoin in development called CNHC. So if I were a small emerging market economy in, let's say, the southeast side of Asia, I would be putting up a CBDC right away, or some other effective digital payment system in order to ingrain the use of the local currency, just as suggested by the premise of Dr. Subbarao's question. But then will the superpowers allow stablecoins to compete in these areas? We don't know yet, but it is a temptation.
Can I just ask one follow-up question on that, Darrell, since you mentioned the possibility of a US CBDC? I think Dr. Subbarao also alluded to this as either a private or a public US CBDC becoming part of the international reserve system. There's this sort of interesting recent paper by Gorton and Zhang, which compares the stable coins to the private banknotes, in the last century. And one of their conclusions is that the value of these stable coins is fluctuating quite a lot, and in a manner that you would think it should if the quality of the money was somewhat imperfect in terms of being able to meet the settlement standards. How do you see this evolving? Do you see this simply getting disrupted over a period of time once these stable coins run into their problems, perhaps in some idiosyncratic manner based on the reserves management? Or you think that these stable coins are likely to get regulated with the purpose of actually ensuring that their value, given the quality of the assets they manage? So sort of, are we looking at sort of strong prudential regulation of stable coins, just like banks, so that, just the way deposit value stays very close to one, the CBDC values, the stable coin values will also likely stay close to one? Then I think it becomes a question of whether US needs a central bank digital currency, or does it need to simply do better prudential regulation of these private stable coins? What's your thoughts on this, Darrell?
Oh, thank you. Yeah, you've asked a $64 trillion question, Darrell. That's the big debate going on in the US right now. And I've suggested that the United States needs to develop the technology for CBDC. But as far as deploying it, it's the last resort. There are other ways to get the US payment system working better. Stablecoins is one of those. Improving the bank rail payment system with regulation and inserting competition into the bank rail payment system and innovation would be my top choice. But going to stablecoins, Viral, you may have seen the President's Working Group report on stablecoins, which came out last month. In fact, Undersecretary of the Treasury, Nellie Liang, who led that project for all of the US financial regulatory agencies, introduced the report here at Stanford University in November, we're proud to say. And that report weighs the costs and benefits that you described are all very carefully: financial stability, investor protection, proper reserve backing, as opposed to the national banking era currencies. And it ultimately recommends that Congress pass legislation requiring that a stablecoin can only be issued by a depository institution, a bank, in other words, regulated for its reserves and liquidity, and the entire regime of liquidity and capital requirements would be behind it. And so it would be in principle as safe as bank deposits. However, even the Governor Chris Waller of the Federal Reserve has said, this is overly conservative. How are we supposed to give banks a run for their money, literally, with competition if the banks themselves are solely responsible for issuing these stablecoins? Whether it happens through this form of legislation or otherwise, I do expect that any significant US dollar stablecoins issued from within the United States will be heavily regulated for prudential, both macro and micro prudential safety. And I expect that, let's say, a CFO in Germany wishing to pay for equipment coming from Ohio would be happy to use the regulated US dollar stablecoin to bypass the expensive correspondent banking system. then I think there is a good marketplace for both cross-border and domestic payments in stablecoins. So I would be, if I were investing in these sorts of enterprises, I would be investing in a well-regulated US dollar stablecoin.
Thank you, Darrell. That was very clear.
Before you move away, can I respond to some of the points made by Darrell? Because we lose the thread. While talking about India, he said that India's case for issuing a CBDC is not very strong because we have capital controls, we're a democracy, we're a large country, we're a large economy. All those points are well taken. But as I said, if other countries are doing CBDCs, India just cannot sit by and watch, especially if industrial countries like the US, Europe, China are doing digital currencies. India just cannot sit back and say that we're a large economy, our capital controls are strong and good. And second, India's capital control defense is not all that strong as people believe it to be. No, cryptocurrencies can jump capital controls. China lost $80 billion last year through the conduit of cryptocurrencies. So India's capital controls are also leaky. But apart from the fear and anxiety, I think India is also driven by some positive considerations, which is the transfer payments. Yes, because of UPI and because of a number of other digital payment systems available, transfer payment costs have come down, but they're still quite significant, especially cross-border payments. Our Indians working in the Gulf today, millions of them still spend about 3, 4, or even 5 or beyond 5% of the money as fees for remitting money home, and that's quite substantial. Even for domestic payments, costs in India are quite low compared to other countries, but they're significant. We just don't see them because they're hidden. You know, when you use a credit card or a debit card or a mobile app, that cost is hidden, is paid by the merchant, and that merchant is distributing the cost via prices. So if we issue a CBDC, I see a possibility of transfer costs coming down, of prices coming down. So apart from fear and anxiety, there's also a positive motivation about bringing transfer costs down, about preventing counterfeiting of currency, about reducing the cost of printing and distributing of currency. So that's the first part. I also want to respond to this issue about stable coins and the point you raised, which is that stable coins are supposed to be linked to the reserve currency, and they're expected to maintain that peg. At the moment, nobody is regulating them. So my point is, who's going to control, who's going to ensure that they're going to continue to maintain that peg? And if they see that no regulator is watching them, what is preventing them from delinking from the peg and creating money independently? Then they become like a bank. And they're not even regulated like a currency, much less a bank. So I think we've got to be more circumspect about the possible ramifications of stable coins, especially stable coins linked to the dollar from an emerging economy perspective. I'll stop there.
Yeah, I have 2 follow-up questions. Let me first start with you, Dr. Subbarao. You mentioned about paper money in India being replaced by digital money. And I think most people at a 10-year horizon would predict that perhaps cash, even in a country like India, which seems to love cash by and large, that cash might disappear. Yet it seems that the last 18 months have been a bit of a paradox in the sense that the pandemic has increased both the circulation of cash in the economy as well as the fraction of transactions which are being settled digitally. Do you think this is just a one-off that is linked to the pandemic, or something else is going on as far as the Indian economy is concerned? This surge in cash that's coincident with the surge in digital settlement?
Yeah, first of all, as a preface, I want to say that lower income people with lower literacy, lower awareness levels have taken to digital transactions in India than we could have possibly imagined. 10 years ago, if you said, can poor people, can your maid, can your driver, can your servant use digital transaction, we'd be amazed about how they could become quite savvy about it. So first of all, to believe that low awareness levels and low income levels come in the way of adoption of digital currencies is a misnomer. But having said that, I take your question, I know where you're coming from. When India did demonetization 5 years ago, the expectation was that people will shift from cash to digital transactions. That happened during that period of about 3-4 months when you were probably in the Reserve Bank at that time. But then people slowly switched back to cash. And then over the pandemic, over the last 2 years, the currency circulation has gone up to about 14%. I believe people are holding cash today as a precaution because there's a lot of insecurity around them and they're concerned about a lot of outcomes, lockdowns, about being able to buy. So I think people are holding cash as a precautionary measure, but the trend, I believe, is from cash towards digital, although cash is not going to disappear.
Thank you, sir. And let me follow up with a question for Darrell. Since the working group explicitly considers some of the financial stability implications of stable coins, one interesting financial stability implication of CBDC that also seems to be flagged. I was just exchanging some emails with Charles Goodhart in UK today morning, and one of his points was that, historically we have treated retail deposits as being a core deposit base of the banking system that won't switch banks at the first sign of stress or bad news about the bank, unlike wholesale deposits. But he questioned whether with central bank digital currency being a possible option for the savers, whether this would necessarily be the case. Since we don't have a CBDC that's been rolled out yet, of course, anything one says on this would have to be speculative. But I just wanted to hear your views on what financial stability considerations do you see from the introduction of a CBDC from the standpoint of the banking system itself, when there were to be some stress affecting a part of the banking system?
That's a terrific question, Viral. And if I had to say what is the main roadblock to the introduction of a CBDC in the United States, it's over precisely the question you just raised. There are technology issues like privacy and the ability to monitor transactions, but the biggest concern, in my view, of the US official sector is that introducing a CBDC, or for that matter, a vibrant stablecoin-based payment system, would disrupt the banks. And the disruption could take two forms. In a stress period, as I think you hinted, they could make it much easier to run on weak banks. The other, I'll come back to that. The other disruption is more long-lived. If a CBDC were effective enough, it would, as you suggested, make it very easy to move your money around, in fact, programmably, shopping for the best deal and competing against the existing payment system. This would be quite disruptive to bank profitable franchises. For example, deposit taking. In the United States, and I think in many countries, banks have the privilege of being able to raise funding through deposits at extremely low, below market rates. And this is viewed, well, by some as a negative. I'm one of those, but by many as a positive, because it would seemingly make the funding of credit by banks more available. That is, if banks, the story would go, if banks can raise cheap deposit funding, then they can make cheaper loans. I think that's a fallacy, because no bank would make a loan to a borrower where the money would earn less than it would if invested in marketable securities. So the hurdle is not what is your funding cost, it is what is the next best available investment. A banker is not going to say, well, I'll lend money to Viral Acharya Incorporated, because even though he's a fantastic, even though I will lose money on this loan, I'll make it up on my cheap deposits, and I can afford to make a loser loan in this case, if you don't mind my using you as a guinea pig, Darrell. So the argument that credit provision would be harmed by making the payment system and the deposit system more competitive is, in my view, not correct, although there are exceptions, and I don't want to go on too long. There are exceptions related to outlying rural banks. The other issue is the issue of runs. And there I do think that the authorities would need to be very careful with respect to how large these central bank digital currency positions could be and how well the banks are protected by capital requirements, liquidity requirements, and lending of last resort, like discount window access. Those mechanisms are all available, and they should not be a roadblock to the introduction of a central bank digital currency.
Thank you. I think we have about 20 more minutes, Coase, before we throw it open to Q&A. Is that correct, Coase?
Oh, I thought we are transitioning at 9:35. So we have about 10 minutes.
Okay. Yeah. Okay, we have about 10 minutes. Okay.
And so then we have 15 minutes of Q&A. That's right.
Okay, excellent. Okay. So I have two quick themes I want to shift towards. One is on the crypto side of cryptocurrencies, and the second is on the asset side of the crypto assets. So let me start with the crypto side first, and I'll ask both of you to give brief responses to this query, if possible, which is one value of, or one characteristic of a currency. One of my fellow deputy governors at the time I started out at the Reserve Bank, DG Gandhi, he always used to say that, any currency, for it to function well, has to have two properties. It has to be very easy to transact in, and it has to give anonymity to the user. So I wanted to come to the crypto part of the currencies, which is that one of the attractions of sort of using these mediums of exchange? Do you think, is it just a coincidence that the growth of crypto has coincided with anti-money laundering rules and the like? And the parallel question then is, if a central bank digital currency technically has records of all transactions staying with the central bank, even if in an encrypted manner, do you think this could be one of the resistances to using the CBDC in the first place? Because maybe the end user thinks, oh, this is really just a central bank, but it's really part of the big government. They're going to see my transactions. I don't really want to transact in this. Whoever wants to go first. Dr. Subbarao, do you want to start out?
Yes. On your first question, Darrell, about the use case for cryptocurrencies. As I said earlier in my remarks, when Bitcoin first came, it came with a libertarian fervor of freeing people from the tyranny of fiat currencies issued by central banks, that it will displace money in all its functions as a unit of account, as a medium of exchange, as a store of value. But in the event, it is not a unit of account, it is not a medium of exchange, it has just become an asset. So I don't see cryptocurrencies now or in the future becoming mediums of exchange or units of account. They might become stores of value, they might continue to remain as an asset class. That is why I think there is a lot of concern in emerging economies, including India. There is a lot of speculation, there's a lot of anxiety, there's a lot of comment and debate about what the government is going to do in the proposed cryptocurrency bill. Are they going to ban them altogether? Are they going to allow them? If they're going to allow them, with what sort of conditions or guidelines will they have for allowing certain cryptocurrencies and not allowing some? We don't know anything at all. But they're all in a black box. But I believe there is really no use case for cryptocurrencies, except that they have become an asset. And as long as people invest in them, they've got to be regulated as an asset, both for financial stability reasons and for consumer safety reasons. So it's something forced on us. It's not something that we would welcome. Okay. If the craze eventually vanishes, of course, central banks and governments can withdraw. On the second question of privacy, I think that's an issue because cash is anonymous. If I go to a grocery store and run up a bill of 800 rupees, I pay in cash. The transaction is final, complete. There is no footprint at all. On the other hand, if I use CBDC, there is a trace of that, there's a footprint of that. It will, of course, prevent illegal activity like money laundering, drug trafficking, etc. But even honest people might feel uncomfortable, like Darrell said, about the central bank or the government keeping track or having access to all transactions. Why should the RBI or the government know how much ice cream I'm buying every month or what luxury brands I patronize? So there's a certain level of discomfort. And I think if you have CBDCs, you have to have very robust data protection laws, which are credible, not only to people within the country, but to people outside. So data protection laws are very, very important in issuing CBDCs. And I'm sure that this is one of the issues that is engaging the Reserve Bank of India and indeed several other central banks. Let's stop there.
Thank you, sir. Darrell, do you want to chime in?
Absolutely. Again, you're asking the best questions, Darrell. So on the issue of the use cases for cryptocurrencies, well, there's a broad set of them. We discussed stablecoins earlier, which are a form of cryptocurrency, and they can have a useful application when properly regulated for stability and all of the other requirements. But there are cryptocurrencies, and I agree with Dr. Subbarao, that are used primarily as an investment asset. And I would think of the situation as close to that of gold. Gold has a number of fringe applications, jewelry, some industrial uses, but by and large, the gold trading in the world is generally around speculation about whether the price will go up or go down. And I know that India, many people hold gold as an investment asset. So I think of many of these cryptocurrencies as speculative assets with a fringe application. What about those applications? Well, some of them are illegal, and I'm going to choose my words carefully because when I spoke about this in the U.S. Senate Banking Committee earlier this summer, I got the next morning 700 extremely nasty tweets telling me things that I should do that I won't repeat here. But some of the uses are illegal. Some of the uses are not illegal. For example, in El Salvador, Bitcoin has been now designated as a recognized currency, mainly because I think of remittances. And there are small countries with weak monetary systems whose currencies are not reliable, where perhaps a cryptocurrency, if there's no substitute, could serve a useful purpose. That said, though, exactly as Dr. Subbarao suggested, they need to be extremely heavily regulated for investor protection and for financial stability, and of course for proper use as a payment medium. And I think that can be done. On the second issue of privacy, I think this is the most difficult design question. There is promise of the computer scientists coming up with cryptographic methods that would prevent anyone other than the receiver knowing that the payment has been made, and in many cases, knowing the identity information of the sender. And that's appropriate for most payments. In the case of the European Central Bank, it's been mooted that every consumer would be allowed up to a certain number, let's say a few thousand euros a month, of completely anonymous payments. But in order to ensure that, you need cryptographic methods. But you also need methods by which you can study the data and detect patterns suggesting illegal payments, allowing you to break open the veil of cryptographic secrecy. And this is a design problem that's still being worked on. It's premature to say that this can be easily solved. And that's why I suggested earlier, a country like the United States should get busy on the technology because it takes several years, not only to get buy-in from the public and all of the agencies and banks and everyone else that will weigh in politically, but also simply to do the necessary design work and field testing. And I think that's why perhaps the Reserve Bank of India is beginning pilot testing. I think it will be quite some time before a satisfactory design can be found. In the meantime, consumers might wish to be suspicious about an entity that has all of the payments data in the economy. China is doing it, but China has a different form of political system that makes that possible. I don't think not all Americans, very few, perhaps Americans would be happy to just say, yeah, let's give the government all of those data.
Just one last question before we take some questions from the audience. Maybe, Kos, you can consider this as a Q&A from the audience, counting me as one of them. And that this relates to the asset side of the crypto, which is that I think Darrell mentioned the similarity between gold and some of the crypto investments. In fact, it's routine in Indian investors to talk about the new crypto bill that is likely to be disclosed in January. In the context of that, to say that it's going to cause cryptos to tumble in valuations and gold to rise. The two are always spoken of in the same vein. The broader question I have then is, to what extent have negative real rates pretty much everywhere in the world contributed to the speculative interest in this asset class, and whether once we reach normalization of these rates over the next 1, maybe 2 years, do you think we risk something like a correction as we had in valuations of gold from $2,000 to about $1,300 in a relatively short period of time in the middle of the last decade? So I wanted to so the question is, what do you think is the role of negative real rates that are being offered to savers in the huge craze that has been created for this asset class? And then after that, we'll take on some questions from the audience. Darrell, do you want to go first?
Oh, sure. I think you've hit the nail on the head, Viral. Very low real rates have encouraged people to speculate on all kinds of things, trying to earn a higher yield. But in my view, they don't even need that. There's a certain amount of, I wouldn't call it mania, like tulip mania, but let's call it very high exuberance about investing in cryptocurrencies, just as they would invest in GameStop or Tesla, without necessarily running spreadsheets of discounted cash flows to figure out what it's really worth at a low real rate or at a high real rate. I don't think they're paying that much attention. There's just a lot of money swishing around with a speculative, let's call it somewhat of a frenzy. And yes, there could be a massive correction because, as Dr. Subbarao noted, most of these cryptocurrencies have literally zero underlying assets. They're simply made scarce by an algorithm. And so, it's worth whatever one is willing to pay for it. And we know what that can lead to.
Dr. Subbarao, do you want to have the last word on this?
Yes, which is to say that I endorse everything that Darrell said, which is that negative real rates are actually driving search for yield. And people are looking for other avenues to invest. And not that there are very many savings in a country like India at this time, but even so, there is search for yield. But I think the cryptomania is quite delinked from this. Imagine if there was no crypto, people would have looked for other possible avenues of earning. But the availability of crypto is, I think, somewhat of a mania, is a frenzy. It's like the tulip mania of the 17th century Dutch tulip mania. And my fear, and I think the government's fear, is that a lot of people are investing in cryptocurrencies driven entirely by I wouldn't say greed, but possibility of earning quick returns. And they might feel cheated. They might, in a poor country like India, that can be a huge tragedy. I think the government is concerned about it. So you're right that it is the real interest rates that are driving search for yield, but I think crypto is running on its own steam.
Thank you so much. We have time for some questions. May I request the audience to raise hands using the raise hands function? Ask only one question. If your question is directed to either Darrell or Dr. Subbarao, say so. But if it's for both of them, you need not say anything. Okay, no one has raised hands.
Pradeep, Pradeep has raised his hand.
Yeah, Pradeep has raised his hand. Yeah, Pradeep, please go ahead. Yeah.
Thanks, Viral. My question is, first to Darrell, and as far as I see it, and I've heard this before, the central bank digital currency would be essentially equivalent to cash, in as much as certain cash which is not issued physically would be issued in digital form. So why should it impact deposit taking by banks in any way? Where deposit taking by banks, people earn interest. On the Cbdc, people earn no interest. Why should anyone keep money lying around in a Cbdc except for day-to-day stuff? And why should it have any impact on deposit taking by banks? I have another question, but you restricted me to only one question.
Pradeep, thanks. It's always a pleasure to get your questions. You ask hard ones. So the idea is, well, people are willing to hold paper money despite it's not paying any interest because it's convenient as a medium of payment. Let's suppose CBDC was so convenient in the following sense. If you thought that you might get a higher interest rate at Chase than you were getting at Bank of America, well, there's two ways to correct the situation. One is to log on to your Bank of America website and spend about an hour going through various hoops and loops trying to get your money moved over, which is I've tried. Or you can, if you're smart, you can hire an aggregator to move your deposits, or you can go to the ATM machine and withdraw paper money. Well, those are various degrees of convenience for the average consumer. But if the average consumer gets very adept at swishing their thumb on their mobile phone CBDC app and saying, swish, there goes all of my Bank of America savings into Chase or vice versa, then the banks are going to have to say, well, I guess we're going to either have to figure out how to put a block on this or we're going to have to pay higher interest rates because we're not going to keep our cheap deposit funding at this rate. So I think it does make a difference provided that CBDC is set up in an interoperable form that does provide that competition. Now, that's not guaranteed. In some countries, and perhaps including the United States, it will be left up to the banks how to deploy the CBDC. The Fed is not going to have everyone walking down to 33 Liberty Street to pick up their CBDC. They're going to have it go through the commercial banks, most likely. And if the commercial banks provide it in a certain form, using certain apps that are not that interoperable with other banks, then the premise of my reply to your question might be void. It might not do much more than what we have now.
Yeah, there is one question in the chat box, if I can direct it to Dr. Subbarao, which is, what is the likely impact of the CBDC on central bank accommodations, such as the measures it had to undertake post-COVID? I would also add to that the need to have lender of last resort be deliverable at a very fast speed if we are fearing runs of the type Darrell was just alluding to.
So the question is, how will CBDCs, how might have they affected the pandemic management by the Reserve Bank of India?
Yeah, I think the question is more broadly, how do you see the central bank accommodative policy get affected by the presence of a CBDC? Will it be facilitated? Will it be required more often? Or will there be some difficulties in transmitting the accommodative policy?
Okay. See, at the moment, there is already facility for commercial banks to have accounts with the central bank. So there is already, banks are already, there is some sort of a wholesale CBDC available to banks, although it's not backed by any cryptography or blockchain. So banks already enjoy that, and they have the lender of last resort facility access from the central bank. So I don't see very much of a change there as far as banks' access to central bank money is concerned. It might become faster, it might become smoother, but I don't see much of a change there. But to link this question with the earlier question, which is about why should central banks offer any interest on CBDC accounts of retail people, retail CBDC accounts? If they offer this is the link with Pradeep Yadav's question. If central banks are already, if central banks are saying that CBDCs are cash, and cash does not earn interest, there is no case for offering interest on CBDC accounts of people with the central bank. But I see a possibility that they might offer interest at some point of time, negative interest rate, for example, in industrial countries like the US, Europe, or Japan, might actually offer negative interest rates on CBDC accounts to make monetary policy more effective. Or even in countries like India, we're very far from negative rates, but even central bank can actually, the Reserve Bank can actually calibrate the interest rate on the CBDC accounts of people in order to make monetary policy more effective and to give traction to monetary policy. But I believe that that should not be done. I believe that there should be a rule that CBDC accounts of people with the central banks will not carry interest, because they're saying that CBDC will be perfect equivalent to cash. And cash in my pocket does not earn interest. There is no reason why my balance in the CBDC account with the Reserve Bank of India should earn interest. But if central banks are tempted to offer interest, the game can change. And I don't know what ramifications that might have.
I think we are just out of time. And, yeah, Darrell, you can have the last word. Yes.
I was just going to second what Dr. Subbarao said and refer to the work of Dr. Ulrich Binzeil, who's the managing director for payments of the European Central Bank, who has actually written very articulate pieces supporting Dr. Subbarao's point that in a negative interest rate setting, you would want to pay negative interest, although they would accept, they would make an exception for retail size deposits. So it'd be a two-tiered system: small deposits, no interest; large deposits, negative interest. But as a political matter, I don't think any large central bank will pay positive interest, because they will be then competing with their commercial banks. And I've never seen a central bank that says, we want to compete with our commercial banks.
I think we are out of time, right, Koos? Or should I take a few more questions?
Can I make one point?
Yeah, let me just get intervention from Koos first, whether we are out of time or not, Pradeep. Then
I think, let me ask a quick question, and then I'll let Pradeep ask a quick question, and then I just want to thank all the panelists and close. Okay.
Koos, sorry to interrupt you. We have many questions from our larger participant list. There are many of them.
Should we extend the time then by about 5-10 minutes, Tirthankar?
I think 5 minutes would be very helpful.
Let's check it's okay with Darrell and Dr. Subbarao.
Sure.
Are you guys ready to stay another 5 minutes? Is that okay?
Sure. It's okay with me.
Thank you. Let me ask a question which we've already treated, but I'm asking a particular. So we discussed the privacy issues. So in other words, CBDC represents major devolution of power to the government. Okay, so you guys talked about it already. My question about that is, though, even though Darrell talked about the data issues and so on, but the truth is, everybody, I think politically, it's a big worry that CBDC does represent the government seeing your transactions or things like that. Now, my question, though, is how would that affect the politics in US, in India, and in China, in the speed with which we make progress on the CBDC? Darrell, I know you can start, and then I'd like Subba to respond, please.
Okay, let me address quickly China and the US, and I'll leave India to Dr. Subbarao. So in China, well, the central bank has already decided under the government's direction, we will collect all the data, and that's that. And so there's no public discussion, really. But the US is a more interesting case. If you had asked this question 10 years ago, Koos, I would have said, well, politically, it's a non-starter. Americans are not going to say, well, we want the government to collect all of our identities and payment data, even if the government were to say, well, we have cryptographic methods for protecting you. By the way, China says it has, quote unquote, controllable anonymity or managed anonymity. But Americans would be skeptical of phrases like that. But if you scroll ahead 10 years, and Americans, particularly the commentariat, people like me, for example, But just the literate reader of the Financial Times is going to say, well, what the heck? China has advanced mobile payments. Cheap. Well, not that cheap, but much cheaper than what America has. And it's fast. It's 24/7, 365. It's wonderful. What's wrong with the United States? Why can't we keep up with those people from China? We're losing the space race. And now the conversation has changed and the pressure is on the official sector. Probably it will be on from both sides. The two parties in Congress have reasons to support this, although they're not exactly the same. So let me stop there.
Subba?
Yeah, thanks, Kos. I think the answer to your question is in the realm of speculation. I can imagine what the government and the Reserve Bank of India will say, that we will protect your data. We will not use it for any purpose except for very authorized purpose, and they will specify when that can be used. But eventually, it will depend on the credibility of the government and the Reserve Bank of India. And in a country like India, where the opposition is very vigorous, there can be fake complaints, or there can be government misusing the data and covering it up. So I can see a lot of political complications coming out of this, just because they have access to data. And data protection laws, as I said earlier, have to be very, very tight and have to be credible, have to be robust. And it's difficult how we're going to have draft such data protection laws, and more importantly, how we're going to enforce them. So it's going to be a very, very tricky technology issue, but as you said, it's going to be a very, very tricky political issue.
Thank you, Subba. Pradeep, and then, yeah, go ahead. May keep it brief because there are a lot of questions. Tirthankar has questions as well. Yeah,
absolutely. No, my point is about when Darrell said about anonymous wallets or anonymity being introduced within the Cbdc system once technology for that develops. First, I'm not really sure how stablecoins and CBDCs are different in terms of anonymity. Push comes to shove, everything it would be completely discoverable in a stablecoin framework as it would be in a CBDC framework. So I kind of struggle, given that stablecoins or any kind of crypto has this huge problem of attracting people for tax evasion purposes and that kind of usage. I find it difficult to see the rationale for the existence of stablecoins if we have good CBDC systems in operation for exchange. That's the only point I wanted to make.
Do you want, Pradeep, you want a response from either of them, or you're okay?
If Darrell and Dr. Subbarao could respond, that'd be great.
All right. Go ahead. You guys can pick.
Dr. Subbarao, please go ahead.
See, actually, I don't see a difference between Bitcoin and its clones and stable coins. They're the same from the point of view of privacy and data protection. I don't see why stable coins are more required or can promote financial stability, and which other cryptocurrencies are not able to do. So I do not see it exactly the way you see, Darrell, that there is of course a difference between currencies which are backed entirely by algorithms and currencies which are backed by stable currencies. From a point of view of financial stability, I think both are causes for concern.
Yes, I agree. And I think the private sector doesn't internalize the data security value that the government sector would internalize, and that the CBDC would be safer and more secure from a data viewpoint. But that's separate from the discussion we had a moment ago. Every day, most of us are signing on to some private service like Google, Amazon, your bank, and filling out forms with all of your personal data, and then scrolling through 10 pages of fine print agreeing without knowing it that you've allowed them to use all of your data. We don't think about that. But then we imagine that if we put all our data in a single government data repository, where anyone in the government theoretically could crack into that, we worry about that. We trust some, and I'm a Canadian, but many Americans would trust, perhaps incorrectly, a private sector person. Maybe it's related to government versus private sector, or maybe it's putting all of your eggs in one basket versus putting a few of your eggs in each of many baskets. But I do think a CBDC would be much more secure in the end, because the government won't allow it to go ahead unless it's very secure. The politics of that are pretty clear.
Tirthankar, can you kind of, what's the word? We have time for like 2 or 3 questions.
Let me summarize quick ones. So there's one, the question asks the panel's view on DeFi, the decentralized finance, which is very in vogue these days, which uses crypto tech to further financial development. What are the panel's thoughts?
Either one, please.
I can just chime in quickly. Go ahead, Dr. Subbarao.
No, go ahead, Darrell. Please go ahead. I don't know much about DeFi, so I think you're better placed to answer the question.
Yeah, I was just going to mention that, I've never understood this term, because I think finance has generally always been decentralized. So it's not like the central banks are lending directly. Maybe they used to at some point, but it's always been decentralized. I think the case for crypto tech based DeFi in India, again, in my case, is not very strong. We have the unique ID verification system. We have a very interoperable payments interface, and iSpert, which is the industry software products roundtable, that think tank which has built the India stack of apps for creating the pipes between various parts of the financial system. They've also created now apps for what is called as the Open Credit Enablement Network. In particular, they've created the concept of an account aggregator, which now the RBI has authorized, where a potential borrower can simply aggregate all of their digital records from banks, mutual funds, insurance companies, tax authorities, utility payments, etc., into a single view that with the borrower's consent can be provided to a potential credit provider. Banks and other fintech lenders can partner with e-commerce sharing platforms to deliver their loans, encapsulate the payments into the payments on the e-commerce platform for ease of collection, etc. So my sense is, in India, the Open Credit Enablement Network, rather than crypto tech, sort of almost the opposite in their language, is what is actually likely to create a digital finance revolution, I think, in the next 2 or 3 years, because we would have a standardized platform for delivering these products. There's going to be tremendous competition because anyone can use these apps using the account aggregator to do credit scoring and connect through e-commerce platforms to the end borrowers, be it individuals or be it micro, small, and medium-sized enterprises.
Thank you, Professor Acharya. Of course, there are many more questions, but I see Professor Damodaran is already here. So, in the interest of time, and it's about 8:30 here, should we move ahead?
Yes. Let me just thank the panelists. Guys, you did an amazing panel discussion. Even though I attend a lot of panel discussions, this has been the most useful and most educational. Thank you so much. I think do we have a break? 5-minute break? Is that right? Tirthankar.
In terms of time, we do really
can take the break. It's okay.
You sure? Okay.
Yeah.
We'll take a 3-minute break just to look the other way and take a deep breath, because Aswath, our keynote speaker, is already here. So, yeah, let's take a 3-minute break, Aswath. Is that okay?
Okay, it's fine.
Okay.
Thank you,
Thank you,
Darrell
guys.
and Dr.
Thank
Subbarao for the
Thanks.
masterclass on crypto and digital. That was great. Thank you so much.
all of
Fantastic
you guys.
discussion.
Wonderful,
Thank you.
wonderful panel discussion.
Thank you. Good
Viral,
meeting
thanks
all
a
of
lot.
you. All the
You
best.
asked just the right questions, and thank you.
Thank you.
Thank
Thank you,
you,
Dr.
Thank you,
Subbarao.
Viral. Thank you,
Acharya.
Dr. Subbarao.
Thank you, Darrell. Thank you, Subba.
Bye-bye.
Okay? Okay.
That's perfectly okay.
Okay, great, great. Okay, we are delighted to have Aswath Damodaran to give us the keynote speech. Aswath is the Kirshner Family Chair in Finance Education at NYU Stern. And I think I'm not exaggerating, he is the most famous professor. I've talked to many students who would say if they didn't get to take Aswath's class, they considered the whole MBA a waste of time. So there you are. Aswath, you have the floor. Thank you.
Thank you, Coach. I call myself the Kim Kardashian of finance. So I don't know whether I'm famous or infamous, but I've got a big social media presence. I'll start with a couple of confessions. I was listening in on the last part of Dr. Duffie and Dr. Subbaro's the panel, the previous panel, and I'm not a deep thinker. So be ready for a change of they're deep thinkers. I'm a dabbler. I think I describe myself as a dabbler, which basically means my interests shift from day to day, from week to week. I never spend enough time on any topic to really get in depth on it. But there are a couple of things I found useful. I also describe myself primarily as a teacher. I'm a teacher first and foremost. And as a teacher, you're constantly looking for structures that allow you to let people get perspective, the big picture. And I'm going to draw on one of those structures today, a structure that I use in every class I teach. I teach a corporate finance class, I teach a valuation class, I teach an investment philosophies class. And this is a structure that I find incredibly useful to get people to understand how to think about corporate finance decisions, how to think about valuation, and how to think about what kind of philosophy to adopt. It's a notion of a corporate life cycle. If I take a look at the title for my session, and if it looks personal, it is. It says, growing up is hard to do, growing old is even harder. Something we can all relate to, right? Growing up and growing old are parts of human existence. I just took that and applied it to companies. So I have this notion of a corporate life cycle that I use as a starting point for my classes. And as I said, it's incredibly useful in understanding how to analyze companies. So let me take you through the corporate life cycle in parallel with the human life cycle. The human life cycle, of course, starts with you being born. You're a baby, then you're a toddler, then you're a little kid, then you become a teenager, and then you're in the peak of your life, and then you get middle-aged, and you get old, and then you die. Morbid thought, but that's how human beings go through life. And guess what? As human beings, we fight aging every moment of the day. How do we know? There's an entire ecosystem that makes money telling you that you won't get old, right? Plastic surgeons, private trainers. And all this is, if you pay me this much, you can stay young again. And guess what? You pay them whatever you want. Eventually, you get old and you still die. Companies go through a similar life cycle. A startup is like a baby. Basically, it's helpless. It needs constant infusions of external help to keep going. And babies become toddlers. And you know what toddlers do? They fall, they get up, they fall, they get up. And sometimes they fall and don't get up. Very young companies are like toddlers. They fall, they get up, they fall, they get up, and sometimes they don't get up. The failure rate among young startups is 70%, 75%. Once you make it through the toddler years, you get to become a teenager. As a company, you know what teenagers do, right? I have had 4 teenagers pass through my home, and they've all done the same thing, which is every morning they wake up, they look in the mirror and they say, I've got lots of potential. What can I do today to screw it all up? Corporate teenagers do exactly the same thing. They have lots of potential, but it's almost like every day they wake up and say, what can I do today to screw it all up? In June of 2019, I bought Tesla because its price had dropped. I considered it to be undervalued. And when I bought it with open eyes. I described it as my corporate teenager. And you can see very quickly why I applied the word teenager to Tesla. Because at Tesla, there's lots of potential, right? But every morning, one man gets up. He looks in the mirror and he says, what can I do today to screw it all up? In the case of Tesla, that man is Elon Musk. And if you wonder, why does he do what he does? Why does he tweet about a Thai diver? Why does he buy Bitcoin when you're a $1 trillion company? Why would you do that? The answer is, there's no good reason. He's a teenager. You make it through the corporate teenage years, you're at the peak of your life. As human beings, you know what this means, right? This is when you can go to bed at 3 o'clock in the morning, wake up at 5 and be a fully functioning human being. Hold on to that thought. That doesn't last very long. But at the peak of their lives, companies, everything they touch turns to gold. Think of Facebook and Google 4 years ago. Think of Apple 15 years ago. Everything they touch turns to gold. You're at the peak of your life. Enjoy the moment while it lasts, because this too shall pass. Because soon companies get middle-aged. Middle age is not bad, but it's not as good as being at the peak of your life. What do middle-aged companies do? They fight aging every moment of the day, aided and abetted by consultants and bankers who say, I can do something to make you young again. But enjoy middle age, because worse things are coming down the pike. After middle age comes old age, and after old age comes death, and companies go through the cycle. One of the most useful exercises for me is to look at a company and say, where would I put it in the corporate life cycle? I've given examples of US companies, but let me throw a few Indian companies at you, and you tell me where in the corporate life cycle you would put them. Let's start with two companies that have been in the news for the last few months, Zomato and Paytm. They're not quite idea companies because their ideas have become products and services. They're young companies, probably closer to teenage than to toddler. And guess what teenage companies do? They do stupid things. So when I hear Mr. Sharma talk about Paytm and describe it less as a business and more as an institution that's going to change India, I say, why would you do that? And then I remind myself it's a teenage company. If you took Infosys, TCS, Wipro, and you think about where they were 25 years ago, they were young companies. They were in the peak of their lives. Today, whether you like it or not, these companies are middle-aged. And let me throw a final company at you. If you think about a company like ITC, your best days are behind you. You can dance around this as much as you want, but if your central business is tobacco, no matter where you are in the world, you're looking at a future that essentially is more downhill than uphill. In fact, as you go through this life cycle, there are what I call transition points. So one of the first transition points is many idea companies never make it to become businesses because the idea cannot become a product. The next transition point is what I've titled the bar mitzvah moment. But no, you're not familiar with bar mitzvahs. Bar mitzvahs are the Jewish tradition of telling you you've grown up. Basically, it's when you're 13, 14, 15, they take you through the ceremony where you go from being a child to a grown-up. It's a discrete moment in time. Today, you're a grown-up. And of course, kids are still 15. They still do stupid things, but it's kind of a transitional moment. Companies go through a bar mitzvah moment. The bar mitzvah moment is when I stop giving you slack and say, okay, just build up users and ask you, when are you going to start making money? Every company has a bar mitzvah moment. So one of the first things I wanted to think about is this life cycle, because this life cycle is going to determine everything I'm going to say for the remaining 30 minutes of the session. Now, if you think about what it is that determines the length of this life cycle, because remember, it's going to be different in different businesses. In some businesses, starting a business is really difficult to do. It requires huge infrastructure, long lead times, incredible amounts of capital. And climbing and scaling up is really difficult to do. So if you think about infrastructure companies, if you think about the automobile companies of the 20th century, think of how many startups in the automobile business started and then crashed. In fact, you look at the start of, towards 1925, 1930, and you look at 2000, 70 years apart, and you look at the automobile companies in existence, they were pretty much the same thing. Every new automobile company that came up kind of crashed and burned. Why? Because it's really difficult to build up a business. But there are other businesses where entering the business is easy, scaling up is easy, you can grow fast. And in fact, much of the technology business, that's been the driving force. It's easy to enter these businesses with relatively little capital, you can scale up. Think of how quickly Uber went from nothing to 425 cities. And technology CEOs boast about this. Look how quickly I can scale up, but be very careful about what you wish for, because the same forces that allow you to grow quickly are going to be the forces that force you to scale down quickly. One of the points I'm going to make later in this session is this corporate life cycle has become much, much more compressed in the 21st century. If you think about the great companies of the 20th century, GE, GM, Ford. Think of GE, right? Founded in 1890. I think it went public, 100 and something years ago. It's had a great run. If you think about GE now, it's a walking dead company. There's nothing left. It's splitting up into pieces. It's really not salvageable anymore, but it had a great run, 130 years. Ford, same way, 100 years. But in contrast, think of Yahoo, a company that was founded in 1991, became a $100 billion market cap company 8 years later, enjoyed being at the top for just 4 years, until 2004, when Google came along and Yahoo went into a slide. And by 2015, Yahoo was done. 25 years from start to finish. I'm going to argue that much of what we do in business, much of what we teach in valuation is designed for the 20th century company. I'll give you the device you see in DCFs that give this away. In every discounted cash flow valuation of a company, what do you see as closure? A terminal value. And what do we assume in a terminal value? Most of the time, for convenience, we assume cash flows last forever. And the argument we give for that is, hey, companies last for 60, 70, 80, 100 years. Forever is not a big deal. It's just a convenience. But what if companies last only 20 years? Maybe the way we think about terminal value and discounted cash flow valuation has to be very different given the compressed life cycle. Something I think about constantly with technology companies, even the very best technology companies have a limited time at the top before things start to level off. So with that structure in place, let me talk about a few implications. A lot of analysts, and especially if you have an accounting background, love balance sheets. Let's face it, the balance sheet is the accountant's favorite statement. And I'll be quite honest, from a valuation perspective, it's the statement I least look at. It tells me the least about a company. But people love balance sheets and the numbers that come from balance sheets. Think of how much of conventional value investing is built around book values. Book values is very much an accounting concept. I'm going to start with drawing a contrast between an accounting balance sheet and what I would call a financial balance sheet. An accounting balance sheet is driven by accounting rules. And if you think about how you break down assets and fixed and current and financial and intangible, but it's a historical document. It records the past. Even fair value accounting is really not about the future. It's about taking existing assets and fair valuing them. An accounting balance sheet is a record of your history. A financial balance sheet is based on expectations for the future. So even if you spend billions of dollars in the past, if those assets are not producing cash flows, and a financial balance sheet will give you no value. In contrast, you could be a company with nothing invested, and I give you a huge value because of expectations. You're saying, so what? An accounting balance sheet is a historical document. A financial balance sheet is forward-looking. The implications in terms of life cycle are very, very, very direct. If you get a chance, take a look at Paytm's balance sheet or Zomato's balance sheet. You know what you're going to see there? Close to nothing. Why? These are young companies. It's not that they're bad companies or you don't think they're worth much, but because there is no history. In contrast, take a look at ITC's balance sheet or GM's balance sheet. You're going to see a lot of stuff. Why? Because you have a lot of history. For young companies, accounting balance sheets are completely and totally useless. I recently saw an article that somebody had written about why they thought Zomato was overvalued. And their entire premise was, look at the book value of Zomato, Look at the market value. The book value is close to zero. The company must be worth. There are lots of arguments to be made against Zomato being valued where it is, but the book value is not even in the realm of topics you should touch. As companies age, balance sheets acquire heft because your history is building up. And as you get to decline, don't be surprised if your market values drop below balance sheet. So if you think about price to book ratios and you map out what they will look like, you can see as companies age, you're going to see that drawing towards accounting. So now let's talk about corporate finance. I mean, one of the classes I teach is a corporate finance class, and I make a big deal about the three big decisions that comprise corporate finance. The investment decision, the financing decision, the dividend decision. Every business on the face of the earth has to make those decisions. In corporate finance, we spend enough time to talk about investment decisions. How do you decide what a good project is? We talk about net present value and hurdle rates. Then we get to the financing decision. We do this dance of what is the trade-off between debt and equity. We talk about tax benefits and bankruptcy costs. And then we go to the dividend decision. We talk about how much cash can a company return. And we often give equal time to all of these different decisions and analyze them. But the reality is, depending on where you are in the life cycle, one of these decisions is going to dominate. If you're a young company, let's start with the easy decisions. How much debt can you afford to have? The answer is none. You have no earnings, you have no cash flows. What the heck are you doing borrowing money unless you're desperate? How much can you afford to pay in dividends? That's easy too. You're a young company, of course you can't pay dividends, which means your entire focus when you're a young company is on the investment decision. Let's face it, right now, if you're looking at a Zomato, Paytm, it's all about making the right investments and growing the right way. I couldn't care less about their financing and dividend decisions because they don't quite matter. As companies mature, your projects start to level off. You don't have as many choices. You start thinking about ways of reducing your cost of funding, and maybe the financing decision comes up front and center. And then you get to the last stages of the life cycle. Nobody in GE should be thinking about investment decisions. Trust me, there should be no NPV calculations going on in GE because there are no projects worth looking at. I can save them the trouble. It's all about getting the cash back to the shareholders in their remaining lifetime. The dividend decision is going to dominate. For a young startup, don't become the CFO of a young startup. Your job is essentially not, you're going to be in the back room. The tech guys are going to be in the front room. The marketing guys are going to be right behind them. You're going to be in the basement room if you're the CFO of a young startup, because clearly there's nothing you can do. Do you even know who the CFO of Tesla is? I've never heard of the guy. Why? Because there's no front and center for a CFO of Tesla. This is not about the financing decision. Which leads me to a follow-up. If you trace through what happens to the cash flows of companies as they go through the life cycle, you know the cash flows for a young company are going to look like? They're going to be big negative cash flows. You're saying, what if it's a really good young company? They'll be even bigger and more negative. And here's why. You're starting off often with a loss because you're a young company. You're reinvesting huge amounts because your future lies in growth. You're going to have negative cash flows. This is called cash burn. And people often wring their hands and talk about how much cash burn there's in a company, how terrible it is. We make a statement. Cash burn is a feature at young companies. It's not a bug. It's the way it's supposed to be. As you mature, your cash flows will turn positive. Why? Because you start to make money, you reinvest less. And your peak cash flows will be when you're in that steady state, that zone where you're middle-aged, you're doing well, you don't have very many projects, and cash is pouring in. One of my indicators for where a company is in the life cycle is I compute the free cash flows of the firm after reinvestment, after taxes. If your cash flows are negative, then you're more likely to be at the younger stage of the life cycle. So there are here a few reality checks. Young companies' cash burn is a feature. As companies mature, you're going to see cash buildups. You see this tech companies, right? If you look at Intel and Apple, initially they were cash burning companies. As they matured, the cash built up. And initially, they did not return the cash. Why? Because in their minds, they were still young companies. So eventually, you know what caused Apple to start returning cash? Carl Icahn took a significant position in Apple and started pushing for cash return. I describe activist investors as the laxatives that markets need to keep going, because essentially without that prodding, you wouldn't have seen cash return. And once that adjustment is made, companies start to return more cash. Apple has returned more cash to its shareholders in the last decade than any other company in history. So if I were advising companies, I have very simple advice: just act your damn age. If you're a young company, stop borrowing money if you have choices and you can raise equity. If you're a mature company, stop trying to be like a growth company. You hold all the cash and try to take projects. And if you're a declining company, for God's sakes, don't try for reincarnation. I know there'll be some Harvard Business School professor who consults for you and says, look, you can become young again. Don't believe them. Reincarnation in companies is more an illusion than reality. I make a statement and I think I can back it up. More money is wasted in businesses by companies refusing to act their age than by any other action. With that structure, let me talk a little bit about valuation, which is where I spend the bulk of my time. I know one thing that's happened to valuation practice, especially over the last 30 years, is valuation has become financial modeling. Most people, when they think about valuation, think about gigantic Excel spreadsheets where they move numbers around, project line items. I've never opened an Excel spreadsheet in a valuation class because I think you've lost your way when you think about valuation as just numbers. In fact, to me, a good valuation is a bridge between stories and numbers. In other words, when you ask me to value a company, I first need a story about the company that I convert to numbers. Unfortunately, we live in a world of specialists. You walk into any investment bank and you look at how they do valuation, it's all about numbers, EBITDA multiples, let's talk about margins. You walk into a VC firm or a founder, it's all stories, and they can't talk to each other. If you want some comedy, it's low comedy. Put a VC and a banker in the same room and ask them to talk about the value of a company. It's almost absurd because one person keeps talking about EBITDA multiples, the other person keeps telling a story, and they say, what the heck are you talking about? So for the last few years, I've tried to make this more and more part of my classes, talk about how stories drive valuations. And to understand why stories matter so much, think about what makes us uncomfortable when we value companies. It's uncertainty, right? As human beings, we don't like uncertainty. We push it behind the curtain. We act like it's not there. But the type of uncertainty you face shifts over the course of the life cycle. If I ask you to value a young company, you're uncertain about the business model. Will there be a product? Who runs the company? A lot of uncertainty, which is micro uncertainty, uncertainty at the company level. But as you look at more mature companies, your uncertainty starts to become more macro uncertainty. You worry about what interest rates will do. You worry about what regulations will affect your company. Both the amount and the type of uncertainty shift as you look across the life cycle. So as you think about the challenges you face, I'm going to argue that this balance between narrative and numbers is going to shift as you go across the life cycle. If I give you a young company to value, let's make Paytm and Zomato the lab experiments again. For God's sakes, don't open an Excel spreadsheet and start projecting line items because it'll get you absolutely nowhere. To value a young company, you need to start with the story. The story is going to drive the numbers. Eventually, you're going to drive the numbers, but the story is going to drive the valuation. As companies mature, the balance is going to shift and you can trust numbers more. So when you think about the balance here with young companies, it's story that drives the valuation because there are really no numbers to base it on. Now, I know people call this speculative, which I think is an absurd word to use in the context of valuation because let's face it, everything is speculative. There's nothing in valuation that's a fact. Everything is an opinion. So what? If you're unwilling to have opinions, don't value companies. Go value fixed income securities over and over again. You'll feel nice and secure, but uncertainty is part of the game. As companies age, you can trust numbers more. Now do you see why value investors, at least the value investors of the 20th century, people who read Ben Graham's security analysis and treat Warren Buffett as a god, have had so much trouble with young companies? Almost everything in old-time value investing is designed for mature companies. Those 12 screens or 11 screens that Ben Graham used to find companies, none of them will find a young company coming through. I don't have the time to go into depth on any valuation, but I would recommend that you take a look at my Zomato valuation from 5 months ago. I wrote a blog post on Zomato. But the point I'm going to make on the Zomato valuation as for the Paytm is the valuation. I'm telling a story about the company. I'm not going to claim I have the story, but I had to tell a story. A story of what? A story of India changing as a country where food delivery becomes more part of what Indians do on a regular basis, and Zomato being the prime beneficiary of the story. This is as much a story about India as it is about Zomato. Because let's face it, if restaurants don't increase at an exponential rate in India and food delivery doesn't grow with it, Zomato is going to crash and burn because there will not be enough of a market for them to go after. But the point I'm making is every number in this valuation, if you point to that number and say, why is it what it is? I'm going to respond to the story I've told about Zomato. Now, of course, differences in those stories will translate into different valuations. In fact, when I did my valuation of Zomato, for those of you who read it, I came up with a value about 41 rupees per share. And for those of you who remember the history of what happened, the initial offering price in the IPO was 71. The stock is trading at 150. And people keep coming back and say, well, what did you do wrong? I said, look, I feel comfortable with my story. This is what I think it's worth. And they said, well, doesn't mean that they're wrong. And I said, no, they might have a bigger story. And that's the thing to remember about young companies is because you're early in the story, divergent stories can lead you to very divergent valuations. In fact, I do what I call do-it-yourself valuations on my blog, where I let people pick their own story for Tesla, for Paytm, for Zomato, saying, look, I have my story, my value, and I invest based on my value. I'm not going to tell you to buy or sell the stock. That's not my job. That's your job. I'll give you the architecture for valuing companies. You take your own story for these companies and value them. But big disagreements about value are par for the course. In contrast, if you take ITC, you could just take a financial model and works because it's beyond mature. Let's face it, it's a company whose best days are behind it. I mean, the Charminar probably accounts for the bulk of the cash flows of the company. When I valued ITC, I actually valued it twice. Once with what the company is doing, which is trying desperately to grow. Right? So it goes in the hotel business, the consumer product business. But the reality is the cash flows still come from selling cigarettes. That growth of 10% you see there, it's not coming from growing cigarette sales. It's coming primarily from growing into other business. I actually valued ITC if they took a different path, which is stop trying to grow. That hotel business is a nice ego business. It's a terrible business for you to be in. Go back to just being a tobacco company. And you know what? I get a higher value per share. I get lower growth, obviously. In fact, I put them in negative growth, but I get a higher value per share for ITC if it did absolutely nothing to grow. See, but the company will cease to exist. So what? This notion of companies being sustainable is an absurd notion. You want economies to be sustainable, but companies are legal entities. If the reason for your existence is gone, for God's sakes, go with it. So when you look at companies, you have to think about what they will do when they age. And one of my favorite examples for this is a company called Severstal, a Russian steel company, which actually shrunk its revenues by 50%. Your reactions, that's terrible. They did it for the right reason. They did it because the steel business was becoming a bad business. And guess what they did? They sold off most of their steel business outside Russia, went back to the core business in Russia, where they make 20% margins. Growth for the sake of growth is a horrifically bad objective. Survival for the sake of survival makes no sense. And Severstal said, growth doesn't create value, we're going to shrink. So as an investor, here's what it comes down to. To be an investor in young companies, you got to be a judge of narrative. When somebody tells a story, you got to be able to ask the questions, is that story make sense? Is it a possible story? Is it plausible? Is it probable? You got to be a judge of stories. That's why the best VCs can't value a $20 bill in a brown paper bag, but they're really good judges of stories and the people who are selling these stories. As companies age, you can be more numbers driven. So if you're this old time value investor, your zone of comfort is going to be mature companies. Which brings me to one final point. I mean, one of the contrasts I draw in my class is between valuing something and pricing the same thing. One of the big mistakes I think we make in finance is we use those two words interchangeably. Why? Because if you think about the roots of finance lying in efficient markets, and markets are efficient, price and value are interchangeable. But I believe they come from different processes and often yield different numbers. We know what drives value. It's cash flows, growth, and risk. We know what drives price. It's demand and supply. Now, of course, demand and supply could be driven by cash flows, growth, and risk, but they're also driven by mood and momentum and revenge in the case of GameStop. In fact, behavioral finance is all about explaining why the price process can yield a different number than the value process can. And if you think about that gap between price and value, almost every investment philosophy that you can think of is built on what you think about the gap and how it'll close. Of course, you could believe there's no gap, in which case you're a believer in efficient markets, you buy ETFs and index funds. You might believe there's a gap, but it eventually closes, which makes you a value investor. Or you could be a trader and you say, look, I don't care about value. I'm going to make money on mood and momentum. So most people don't value companies, they price them. And to price a company, you first need a pricing metric, PE ratios, EV to EBITDA. All of those are just pricing metrics and comparable firms. In pricing, you're not trying to value a company. You're trying to come up with a number for a company based on what other people are paying for similar companies. And if you think about that pricing metric, early in the life cycle, the pricing metric can't be to earnings or to book value. It might not even be to revenues. It might be to potential markets, gross merchandise value. And as companies mature, you're going to see the pricing metrics shift with them. One final point. I mean, often, one of the big, last week, you saw the news story about Jack Dorsey leaving Twitter, which brought up this debate again is, should founders stay on as CEOs? Who's the right kind of CEO for a company? We've all been sold on this notion of a great man CEO. You know what I'm talking about? Harvard Business School, McKinsey have painted this picture of these are the characteristics that make for a great CEO. But that can't be true. Because you think about CEOs who become leading CEOs, think of Elon Musk and Jack Welch. And put Steve Jobs in there. You put the three people in a room, they bear very little resemblance to each other. So let me make my final point. When you think about the CEO for your company, your CEO has to match where you lie in the life cycle. If you're a young company, you know who I want as my CEO? A storyteller. Somebody who can tell the market a story, convince them about the story, and get them to invest based on the story. If you're a mature company, the last thing I want is a storyteller. I want somebody more pragmatic. In fact, a few years ago, I actually came up with these acronyms for the perfect CEO at each stage. Young company, your perfect CEO is Steve the Visionary. As you build up, you want Bob the Builder. Then you get to be a mature company. You want Donna the Defender because you're defending your company against competition. And you get to be a declining company. You know who you want as your CEO? You want Larry the Liquidator. If you've never heard of Larry the Liquidator, you should watch this movie called Other People's Money. And Danny DeVito plays the role of an activist investor who takes over this old, past its due date company and breaks it up and sells it. There's no one person who's going to be the best CEO for the company. The last thing I want, in fact, you could argue, and this may be controversial, that Tim Cook is the perfect CEO for Apple in this decade. And Steve Jobs would have had a really tough time with Apple as it exists today. The right CEO of a company should reflect your life cycle. And as the emphasis shifts, managers need to shift with it. One reason I think Jack Dorsey had to leave. He was a great CEO when Twitter was a startup. But he had, I mean, this may sound harsh, but Jack Dorsey is not a great business builder. I mean, if you think about Facebook versus Twitter, think about how much better Facebook is as a business than Twitter is. I mean, you could blame the social media platform, but the reality is you need somebody who can build a business. So use that as your judge of, do we have the right CEO? And for family group companies, this is going to become problematic as companies start to change, because sometimes a CEO made complete sense for a company in one decade will not make sense in the following one. So I want to give people enough time to ask questions. So I'm going to stop there, but I'm going to close with a quote that I heard, which is, growing old is mandatory. Growing up is optional. I love that quote because, you know, people try to stay young and they try to do stupid things to stay young. Companies do the same thing. And as I said, as company life cycles compress, we need to rethink how we do valuation, how we think about corporate finance, and how we think about the right CEOs for a company, because you're going to see a lot more management turnover as a consequence of this compressed life cycle than you used to. Now, I'll close with this thought. If you think about Henry Ford, right? Great CEO for Ford when it was a young, growing company. But even towards the end of his life, the 1940s, he was already the wrong guy for the company. But time took care of it. He died and his grandson became CEO at the right time. Time took care of problems in the 20th century. Time is not going to take care of problems in the 21st, because companies are going from young to old so quickly and from old to declining so quickly. You're going to see a lot more management turnover as a consequence. And you're going to need a lot more activist investors to make that happen. So that's all I had to say. So I'm ready for any questions you might have, and I'll stop my share so that I'm not taking over the screen.
Aswath, let me ask a quick question and then open up the floor.
Okay.
Very, very interesting, very thought-provoking talk. Now, I recently reviewed a paper where they were talking about this regenerating a company. And exactly as you said, what they were really doing is they were basically keep the same company and going into a different product. In other words, a new product, basically.
That's the dream, right? And I'll tell you, the two ways they back it up. One is they give anecdotal evidence. And you know, the two companies they give as examples, right? Apple with Steve Jobs coming in 2000, turning the company around, and Microsoft with Satya Nadella, right? In 2013, when he came in, Satya Nadella was taking over a company that was a two-hit wonder. Office and Windows, had never done anything that created value elsewhere, and he found the cloud business. With oil companies, you know what the dream looks like right now, right? Oil is a shrinking business. We're going to go into green energy. So the dream is I can pull that off. And guess what? 1 in 100 companies does it. But the other 99 try, they throw billions of dollars. It's great for consultants. It's great for bankers because you have lots of acquisitions. You have lots of money thrown at problems.
So you're saying there is no circumstance where it makes sense. Basically, don't do it, start a new company, go with a different story. That's what you would say.
If I were advising ExxonMobil or Royal Dutch, I'd say stop trying within the company. If you want to get into green energy, spin that off as a separate company because your name is toxic in the green energy space. I will not buy my solar power from ExxonMobil Solar Power because ExxonMobil is not a name that attaches solar power. It's the reason why I think Tesla. Because every year over Tesla's existence, I've been told that GM and Daimler have such good technology, they're going to drive Tesla out. And guess what? 12 years later, they're playing Tesla's tune. Why? Because when I buy an electric car, the brand names I think about are not GM. It's really more iPhone than car, right? It's an electronic device. And to me, Tesla is way ahead of everybody else. So when people sell this notion of reincarnation, can it be done? Yes. But are the odds with you? Absolutely not. So unless the stars line up, I'm not going to push for reincarnation. I'm going to say you're better off just letting time take its toll and finding a different way to be in this business.
Thank you. Okay. let's open it up for other questions. Tirthankar, are you seeing any questions?
So Damodaran, thank you so much. There is a promise of your any of your your lectures, and this is delivered higher. This is where the valuations you were conservative. Actually, anyone we trying to value your lecture has been conservative. That's the one thing I would say. Before I go into questions, yes, sir, please.
No, we'll go into your questions.
Before I go into the questions, I would like to just remind audience that Professor Damodaran's presentation has been shared. I have got questions saying, will this presentation be available? It is available and it has been shared, and we will share it once more. So with that, sir, a quick question to you. Let me start this. We've had comments, not too popular comments in the recent past, where the CEO of a giant US bank said, "We will last longer. We will last longer than 100 years."
China. Jamie Dimon took that back very quickly. So, we don't say that about China. Yeah.
What's the thought there, sir?
No, I think it's hubris. It's hubris because I think that companies should not be viewed as forever entities. That's why I said this whole notion of, I do this session on what I call the theocratic trifecta: sustainability, ESG, and stakeholder wealth. Absolute nonsense, nothing there, complete mush, but think of how much it's been sold. I considered doing an ESG session, but the way I describe it is I come to bury ESG, not to praise it. I think companies should not think about lasting forever. The analogy I would offer is think of those Egyptian kings who wanted to last forever. You know how they tried to do it, right? When they died, they wrapped themselves in bandages,
Mummies.
put themselves in a tomb, surrounded themselves with their favorite products, and guess what? They stayed dead. A company that tries to stay alive is like a zombie. One of my favorite TV shows is The Walking Dead. This show where people they die, but they stay. There are a lot of Walking Dead companies where you say, what the heck are you doing still around? Take a look around India. There are companies you look at say, your due date is well past its existence. What? Because from the perspective of the entire economy, you don't want these companies to be around because you know what they do? They suck up capital, they suck up talent, which should go somewhere else. I give the contrast between Europe, and Europe is full of Walking Dead companies because for whatever reason, the European tradition seems to be you can't let a company die. It's such a waste. So we'll keep these companies alive. So they stay alive. And guess what the cost is? There is no capital for young startups. There's a reason why the great tech startups haven't come from Europe, outside of Spotify. They come from the US because European companies suck up capital. They try to get into every business and they stay alive, but at huge cost to economies. So if India wants to map a path forward, they've got to let companies die. It's not a popular statement because there will be people who will lose their jobs and lose their money. But if you keep companies propped up after their due date, you're going to suck all the vibrancy out of the economy, all the capital out of the economy to keep these companies alive.
Professor, there's another question. So you mentioned that the life of companies has decreased, the life cycle. Do you see this continuing? Do you see companies becoming?
I hope not, because it'll get really, if the life cycle is 3 years, you're going to look at, So hopefully that life cycle change has happened because it's primarily with technology-driven business. If you think about the contrast, let's think about Marriott versus Airbnb. Right? A hotel company in the old days to build up, it took you a long time to build up. Why? Because you had to build hotels, infrastructure, money, capital. But if you think about Airbnb, you're an intermediary. You can go from nothing to 100 billion in no time at all. And you celebrate that growth, but it also means that you're only as good as your technology platform before something else emerges to essentially take your place. So I think that we've made that transition to these low capital intensity businesses, but it comes with a cost. They're going to be much more volatile. Their lifetimes are going to be much shorter. And we have to accept that trade-off in markets as, hey, that's what we're getting for that steep growth curve.
There's another question. This is from Yakov Amihud. Is the inference that cash flows have different predictive power in younger and older companies? That is,
I think, and I absolutely think so. But I think the lesson I get from that is if I'm investing in young companies, I need to own 100 companies to diversify across different businesses. If I own mature companies, there's old rules of, I think if you look at old textbooks in finance, you get to about 20 or 25 companies. People tell you, well, you're diversified enough. That presumes you're investing in nice mature companies. What terrifies me in this market are the people who put half their money in Paytm and half in Zomato. Are you asking for trouble? I mean, the lesson I get from unpredictability is I need to be, again, this is hubris getting in the way of good investing. Basically, I know I'm going to be wrong 100% of the time. The way I try to protect myself is by spreading my bets even more across countries, across sectors, across life cycles, because I'm going to be horrifically wrong on every one of my young company valuations.
Here's another question. This is from J. Ravichandran, a very senior NSE. Does the aging concept, that applies to corporates, also apply to markets, developing, emerging?
Yeah, probably. I think that stock exchanges, the clock is ticking, right? I mean, there's a reason we created stock exchanges. They were created in a time we had to physically meet in a space to trade. Those days are gone. Everything is happening offline. The question we got is, do you really need an exchange to have this? You need some kind of platform. The question is, what do you call that platform? So unless exchanges keep up with the times and recognize that it's not a physical space anymore, that it's a platform where transactions happen, I think that's the recognition that we need to bring to this process. We can't stay wedded to the way we thought about this business because the business itself is changing. So I don't think exchanges are going anywhere because we still need platforms. The question is what the margins are going to look like on those platforms. So the business model for exchanges is going to change. My guess is you're going to go for a higher turnover, lower margin business. You're going to see a lot more trading and you've got to get a lot smaller slice of this. I'm not sure what happens to all the market specialists and this infrastructure you've created from the old exchanges, because those might not survive this transition.
Thank you, sir. There are two questions. I mean, they're related questions, so let me just combine them. The point is, does your aging theory work for FMCG companies as well?
Yes, but it takes a lot longer, right? They last a lot longer because what they're producing is not high tech. It took them a long time, to get where they are, but because they built up brand and the kind of competitive advantage they built up are fuzzy, and it's very difficult to say, how do I get that? So I think their life cycles tend to last a lot longer. They live in that mature phase for a lot longer before decline starts. I mean, I think, you could take your favorite company and think it through that process. It's tough to make it into this business as a successful business, but once you're there, you can stay on that plateau for a lot longer. And if you have a country like India, where you're getting growth coming from the population, getting more prosperous, you might be able to still continue to post reasonable or even high growth rates during your mature phase, because the country growth is giving you that ballast.
Okay. Here's another question, Professor. Has the value of numbers in valuation declined in recent years, given excessively frothy valuation, near zero interest in valuation?
I don't think the value of numbers has declined, but the market has changed. And here's how it's changed. 40 years ago, companies in public markets had business models, and even if they didn't have profits, were well on their pathway. I give the example of Apple and Microsoft when they entered markets in the 1980s. Both companies were either making money already or on the verge of making money. What's changed is now you're getting companies in the public marketplace who used to stay private. A Paytm would never have been able to go public 20 years ago, 40 years ago. So what's changed is the market has changed. It's not that you can't use PE ratios, but the sectors or the groups of companies you can use PE ratios has become smaller. So it's not that the value of numbers has changed, but lazy number investing. You know what I mean? The lazy number investing, which is what the Ben Graham school leads you to buy stocks with low PE ratios and everything. It's basically trusting mean reversion to make your money. That's no longer going to work because the market itself has shifted under us and those old. So when people wonder why has value investing stopped working, and it stopped for the last 20 years, it's not because the techniques have changed, but because the market itself has shifted. There's a reason Warren Buffett has become a very average investor over the last 20 years. He's doing the same things he did before. But the problem is, and that's why I tell people, look, if you keep avoiding companies you don't understand, guess what's going to happen as you get older? Your market's going to get narrower and narrower. You say, I don't understand the smartphone thing. I'm not going to buy it. Stop thinking about things you understand. Talk to younger people, see what they use, because that's where the future of investing might lie.
Have we overshot this? I mean, we've had companies that had zero revenues and $100 billion valuation.
I think I wrote a paper called The Big Market Illusion. To call it a paper, I think, is overstating it. Basically, here's the point I made. I said, look, when you see a big market, let's give the big market a name. Online food delivery. We know it's going to be a big market. And we have young companies starting up. Here's what's going to tend to happen. Investors are going to latch on to their favorite company, tell a big story. Why? Because the market is big. And every company, investors are telling the same story, pushing up the price. The collective revenues they're forecasting are actually much greater than the market can sustain. In other words, they're collectively over. So it's not that they're over optimistic on their own company. They think they're doing what they think is reasonable, but collectively they're overshooting. I think we have a lot of disruption happening, electric cars in the automobile business, online food delivery, and people are looking at these big markets. They're telling macro stories to justify investing in companies, but they're not doing the homework of asking, well, who's going to win in this space? Because remember, the space is open. There are other companies entering. This game is not done. We can all agree that online payment in India is going to increase over time exponentially. I think that's the easy part of the story. The question is, who's going to win in this? If you bring in the effect of UPI and the fact that Paytm is not the last player, there are other players that are going to enter, you have foreign players coming in. The question you got to ask yourself is, what will that future market look like, even if it's a huge market, and will my company be one of those winners? And that's a question people are not asking carefully enough. They're just investing based on the story.
So I kind of know your views on this, but here's another question. Would a company that embraces ESG live longer in terms of your aging cycle?
Its consultants will get richer. That's the only thing I can say. Okay? I've called it the most overhyped, oversold concept. And I'll tell you why. I'll actually bring my argument down into four very simple things. One is goodness. You can never measure. Why? Because it's person specific. What you define as good and what I define as good can never converge. So this notion that services can measure which companies are good and which are bad already is a lie. You've built an entire, I won't even call it discipline because that's giving it too much weight, on something that cannot be measured. The rest becomes academic, right? Because if you cannot measure goodness, what the heck are you doing telling me to invest in good companies or telling companies to be good? You don't even know what goodness is. So I think it's a lot of people, that's why I called it the gravy train. A lot of people are making money off this gravy train, but none of the people who are benefiting are the people ESG is supposed to help.
We've read your article. You also mentioned it. It's a constraint optimization problem. How can it possibly give you better results than
from an investor perspective, but from a company perspective, I was willing to listen. Tell me where. Is it going to give me higher cash flows? Is it less risk? There's not a single reason that's been given that I can see backed up by the data.
I have question for a couple more. I have time for a couple more questions.
Yeah, absolutely.
Do you think that some of the multi-billion dollar valuations of certain pre-revenue companies or those in concept stage is a reflection that the base of VC investors has moved beyond normal VC and now includes potentially dumb money?
Well, it's not. That's not even. It's a fact, right? If you think about what's happened, is you created this gray area because it used to be that private companies were VCs invested in and public companies for public market investors. Uber raised money from Fidelity when it's still a private company. So what's happening is public market investors are in the private space. So this line between public and private market investors is gone. And what's driving it is greed. Fidelity invested in Uber because they wanted to make the 50% return as well. And the good news is private companies now have access to more capital. The bad news is it's making them lazy. Because they can take longer, they can scale up, they don't have to build business models, they keep accessing capital. And the hidden story here is the fact that interest rates are really low. You're saying, why does it affect it? People are desperate for yield. They want to make returns. And in fact, I would argue that what you're seeing in the crypto space and NFTs is a direct consequence of people saying, look, I've given up on financial assets because I'm not making enough money. I'm going to go somewhere else. It used to be gold that we went to. Cryptos have become, I describe Bitcoin as millennial gold, precisely for this reason. You're 35 years old, you're desperate, you're scared, you no longer buy gold, you buy Bitcoin. Now, so I think that's a reflection you're seeing even with these young companies, is people throwing the money at something, hoping to make that 20% return.
There was a recent article in The Economist that took a favorable view of how the VC industry has delivered so many, good alpha generating companies over the last several decades, but now it's becoming too big, so returns are necessarily going to be much lower going forward.
The truth will eventually win out. I mean, it is the nature of markets, is you can have extended periods where people do stupid and lazy things and make a lot of money, but eventually the truth comes out.
So here's a question from Madhu Kalimpalli. He's basically asking if this aging concept can be extended to populations or even leaders.
Yeah, actually, Europe is, if you ask me what the future looks like for Europe, it's bleak. There's reason interest rates are low is when you have an aging because think of Japan, right? Think of what happened in Japan over the last 20 years. Europe is looking at Japan circa 1995, and the future doesn't look great. The US presumably will look like Europe in about 15 or 20 years. Immigration is what's kept the US. But eventually population, but I think the problem is China is going to face that problem much sooner than most countries because of its one-child policy. The population is going to age much more quickly. It's a challenge when you're India and China, because on the one hand, you can't afford to have a growing population. On the other hand, anything you do to kind of cut that growth is going to cause your population to age. There's enough slack in India that you have some time before that happens, but aging populations are not compatible with robust growth and solid economies, especially as the aging gets to 50, 55, 60, because you have a larger portion of the population that has to carry that portion that can't work anymore.
So the recent National Family Health Survey actually put India's TFR, total fertility rates, at about 2. So the population is sort of peaking out at this point. Maybe in the next, 1 or 1.5 decades, India's population will sort of peak out. So I have time for one more question for you.
Sure, absolutely.
I don't know how many to choose here. How does one translate a narrative of a high growth tech, healthcare, fintech company into a tangible parameter to value and price when no comparison is available?
There's always a comparison available. You just have to reach for, I'll give you an example. I valued Airbnb, right? There's really no company like it out there. Yeah. But I looked at Expedia and Booking.com, and I looked at Marriott. When people say this is a new business, come on, there are no new businesses. There's just new ways of delivering old businesses. You start there, and then you got to make your best estimates. I think what worries people is not that they cannot do it, but they're worried of being wrong. Now, I tell you, the 3 most freeing words for me in investing in valuation is I was wrong. The more willing I'm to say that, the better my stories become, because to be able to change my story, I have to say I was wrong. You know what, with Zomato, I'm willing, maybe they will start delivering groceries and be able to pull it off with high margins. I'm waiting, because if that happens, I'm going to revisit my story, because I don't think that's a viable path for them to become a valuable company, because the grocery business, the margins tend to be about 1/4 or 1/5 for delivery as the restaurant business. But maybe they can find a way to do it. So to me, the door is always open to changing the story. And if you're willing to do that, then you can always make an estimate, because the worst thing that can happen is you're wrong. So what? Nobody dies. It's not the end of the world. And maybe you write off a few percentages of your returns, but life goes on.
I think you answered this particular question in your talk. Is diversification an answer against aging?
It is. Absolutely. That's why when I wrote on Paytm, I said, for God's sake, if you're buying Paytm, don't make it 50%, make it 5% of your portfolio. And that's something that people have to bring in, because there's, again, this very bad advice you get from old time value investors, which is you should concentrate your portfolios, that if you hold more than 5 or 6 stocks, it's a sign of weakness, that you don't believe your own story. Let go of that. It's hubris to say, look, I have a story that I'm so confident about that all I need is 5 stories to make money. So spread your bets. Absolutely.
Fair enough. Fair enough, sir. Because I have many more questions, but we are at 9:35 at this point. So what do you think we should do, sir?
I can say on the course, there's probably other things on his agenda. So,
No. It's entirely up to Aswath, actually.
I can stay on. So if you want to ask, if you want to go 5 or 10 more minutes, it's fine.
Yeah.
So.
Let's limit ourselves. Let's not overtax Aswath's generosity. Yeah. Go ahead.
I'm wondering the same. We should don't overstay the welcome, sir. You see a lot of foreign capital. This is slightly more general question, Doctor. You see a lot of foreign capital diverting to India, given the uncertainty around government regulations there in China?
I do see, but remember, foreign capital is a mixed blessing. Foreign investors are sheep. They either all buy together or they sell together. So the downside of having this foreign capital is you're going to get a lot more volatility in the Indian market, right? Because there's the slightest tinge of trouble. They're all going to, it's almost like they all hang out in the same room, buy the same things, sell the same things, buy at the same time, sell at the same time. So if you're willing to live with that volatility, it's obviously a good thing, because that capital will come in and push up the prices of stocks. But I think it's like everything else in finance, it's always a mixed blessing.
Sir, this is for my friend Jay Shankar. Can we apply the aging concept to technological innovation in terms of impact on productivity?
Probably. I think that in a sense, when you talk about disruption is a symptom of aging, right? So when you talk about disruption in technology, you're talking about how quickly these technologies move on, which is what makes the companies built around these technologies have limited lives. So if you're thinking about technologies are going to shift. The technology of today is not going to be the technology of 15 years from now. The way we store data 15 years ago is not the way we store. I mean, think of how much the technology of storing data has changed over the last, I still have my first Mac, the first Mac that I got in 1981. It came with this floppy disk that you had to keep swapping because it didn't have a hard drive. Okay? It had what I think the limit was 128K. 128K was the limit. Okay? Think of today when we store stuff in the cloud. This is not the end game. But I'll tell you one place where you're going to see technology kind of change. You think about, SpaceX and you think about Virgin Galactic, you're going to see some of the cutting edge technology shift so quickly that you look back and say, really? I thought that was going to be the technology that won. So again, I think the advice I would have is stay humble, because nothing is forever. When you think that something is the dominant game, I think of Yahoo in 2003. I remember reading an equity research report saying, Yahoo's mastered the search engine. Nobody's going to break the stranglehold. In 2 years, it was gone, right? So as you hear people make these absolutist statements about, Facebook has social media nailed down. Guess what? This too shall pass.
Sir, does an emerging country also need a CEO as a storyteller?
Absolutely, right? Absolutely. A country is selling story. The story, unfortunately, that India has stole for most of the last 40 years is we have a lot of people, right? That is part of your story, but it shouldn't be the central part of your story. All you have selling India is, look, we have 1 billion people. It's a competitive advantage, but it can't be your key competitive advantage. So I think that there is, and India, I think for 40 years has had a good story that can be told. But remember, when you tell a good story, you've got to act consistently with that story. I've heard a lot of politicians tell good stories about India, but then they act in ways that are completely inconsistent with the story they've told the rest of the world. Right? So you can't sell India as we're ready for global competition and then protect Indian companies from competition in certain sectors and we're not ready. because those actions are not. So it's not just telling a story, but staying consistent with the story. Telling the story is the easy part. Staying consistent is going to be more difficult, especially when you have an election every 5 years. It's the advantage, I think. It's unfair that a dictatorship or an authoritarian government has over a democracy is they can tell a story, they can act on that story, knowing fully well that even if there are negative consequences, they can't get voted out. So I'm not making a suggestion we should become authoritarian, but I'm saying democracies will always struggle telling consistent stories and acting consistently because you got to get elected in the next election, and that might get in the way of whatever story you've told the rest of the world.
So my very last question now. Question is about, companies may not last, but sectors do last. How should we How should we think?
Because they meet basic business needs, right? You need soap. So the soap business is never going away, but the way the soap business is structured, and so that's why I said there are no new businesses. We need to move from point A to point B. Logistics will always be a need. Whether we do it with electric cars, gas propelled cars, or something else, scooters, I don't know what it is. So if you define sectors broadly in terms of meeting basic human needs, those sectors will always be there, right? Food is always going to be a sector. How the food business is structured can shift over time. So of course, sectors are going to stay the same, but companies within those sectors can look very different than they did 20 years ago, 40 years ago, 60 years ago. The car service business, until 10 years ago, was mostly taxi cabs and private car service companies. Today, it's the Olas, the Didis. Think of how quickly the business changed. It still meets the same need, but it's a very different set of companies with very different competitive advantages.
Absolutely. Professor Damodaran, thanks so much. I have to tell the audience, there are questions like, is the recording of this session available? Of course, it is available, and we are so pleased. Thank you so much. What an exhilarating talk, sir. Thank you.
Maybe next year I can come in and bury ESG for good. So we'll do an ESG session because I've
that'll be wonderful. Yeah, in fact, we thought you might do ESG actually.
But it would be boring.
But have you over for ESG, sir? Please, it will be our pleasure. Absolutely.
Exactly. Yes. Thank you so much, Aswath. This was wonderful. It was really wonderful.
Take care.
Thanks ever so much.
Thanks a lot.
Bye-bye.
Bye.
So,
okay, let me finish. Let me just say one word, and Tirthankar, I want you to finish. I just want to invite everybody for tomorrow. We have a wonderful show tomorrow. Just remember, we have tomorrow we have research papers and policy papers. On the third day, we have Mike Spence, a policy paper and a couple of research papers. So we have an exciting program going on. Please come. Tirthankar, take over.
Ladies and gentlemen, we just saw what an exhilarating session it was of day one. We had a fabulous paper by Nirupama Kulkarni and Akshat Singh, and then a discussion on a topic that's absolutely and crucial for India at this point on cryptocurrencies, digital currencies, and some very erudite thoughts coming from central bankers and a doyen in the field of asset pricing, Professor Darrell Duffie. And then we had the Dean of Valuation, Professor Aswath Damodaran. He delivered more than a century, clearly. So I can just see the set of questions that still haven't been answered. We would have been going on for another hour. So on that note, thank you so much. And I think we should call the evening to a close at this point.
And tomorrow we start at same time, 18 hours. Yeah.
1800 hours.
1800 hours.
Thank you.
Thank you, guys. Thank you, Pradeep. Thank you for coming.
Take care. Take care, everybody. Good night.
Bye. Thank you.
Recording stopped.